think we've had a great run. I think investors should feel good about that.
The AI theme has kicked back in.
The AI bullishness is there. I don't think that has changed.
Overall, these foundational supports are what's driving markets.
I do think investors do need to prepare for what could feel like a very different second half.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. 4 consecutive record highs on the S&P 500 with U.S. earnings kicking into high gear. The spotlight shining brighter on central bankers as they debate the need for more rate cuts with a little extra pressure from President Trump. Earnings, meanwhile, painting a mixed picture of the U.S. consumer. John and Annmarie are off today doing some personal research into the travel industry, but I am not alone, and we are all lucky for that. Danny Berger is joining me for the next 3 hours. Danny, just another quiet week in the decade that is 2025.
Yeah, 2025. It's been so quiet. This week, quiet. Everything from hard hats to Powell getting slapped on the back from Trump to companies warning of billions in tariff hits. You wouldn't know it by looking at this market. To your point, a 4th consecutive all-time high, the 10th all-time high in less than 24 sessions, in which, by the way, during all that time, the S&P hasn't moved more than 1%. The longest streak it's done that since October of last year. It is as if the summer melt-up is in full force.
Yeah, summer melt-up is the right way to put it. Just each day eking out just a little bit more in terms of gains. And we are getting some color around corporate America and, frankly, global corporations and how they're adapting and adjusting to tariffs. It's a mixed picture. It's really a lot of strength for the most part overall in the United States, but across the world, a little bit more in terms of potholes.
It's so true, but I think some of the animal spirits are back, and you get this from a lot of the financial firms. There was Blackstone earlier in the week. John Gray was speaking to the FT saying that confidence has been restored, that the animal spirits are back, that M&A boom is coming. Goldman Sachs, we also learned this week, isn't going to do their second round of job cuts as planned. So that combined with a market that's rallying, even though there are pockets of weakness, we can look through it because of the animal spirits, because of this confidence that seems to be restored.
And we'll get into the meme stocks and some of the evidence of froth there, as well as the margin pressure that people look at in terms of just how much leverage there is being built up in the system. But I want to speak up to what Michael Hartnett was talking about with his bubble concerns, where he said, when you have the idea of loosening fiscal policy at the same time as loosening government regulations around the financial sector, this is when you end up with true bubble risk. So he started to raise this in a note this morning. What do you make of this sort of idea that down the road this could be problematic, but in the near term, well, it's unclear what this means?
Well, kind of the best thing you can do when a bubble is starting is go long, is ride the bubble. That's kind of the trade to do. But of course, in the long term, it's an issue because of leverage, which you highlighted. Other things get dislocated. It also brings to mind something Ian Lincoln said earlier in the week, that as stocks start to hit a record high, as you get retail traders who are putting it all in and gambling on these types of meme stocks, that you get back into this environment that maybe you need to start asking, is a wealth effect coming in that's just going to exacerbate inflation and exacerbate inflation at a time where we don't know what tariffs will do in terms of stoking prices. So maybe that needs to be another factor on the Fed's mind as they try to navigate where policy goes from here.
Next week is a big week. We've got 38% by market cap of the entire S&P 500 reporting earnings. We have, of course, the Fed's meeting. A lot of eyes are going to be on that, particularly from the White House. And then we've got the jobs report all coming together at a time when people are starting to worry about a bubble, and that means maybe you need to get in even more so right now. In markets right now, very quiet. You're seeing not a lot of action. Stocks basically fluctuating between gains and losses, a little bit down on the NASDAQ. You could see bond yields creeping a little bit higher, particularly on the front end after yesterday's ECB decision that really suggested maybe they could stay on hold. Coming up this hour, we're going to be speaking with Max Kettner of HSBC as stocks look for a 5th straight day of gains. Jason Thomas of Carlyle on the impact of AI-related capex boom on the U.S. economy, and Tom Fitzgerald of TD Cowen following mixed results from the airlines. We begin this hour with stocks looking for a 5th straight day of gains, fluctuating between gains and losses following a busy week of tech earnings, trade deals, more of those on the horizon. Max Kettner of HSBC joining us now. Max, the last time we spoke to you, after being a raging FOMO bull, you really pulled back a little bit. So where are you as we look at sort of new records being made every single day? Do you lean in or do you lean out?
Yeah, good morning, Lisa. No, still very much leaning in. Of course, we wrote a note this week where we explored what could go wrong, but very much stressing could go wrong. It's not, I really don't really subscribe to the notion of this being a bubble. I think it would be a bubble if there wasn't growth behind it, if there wasn't earnings behind it. But the reality is, don't even look at the Q2 reporting season. Let's look at the last reporting season. We had a way above average earnings beat rate. We had way above average surprise factors, and it's starting once again. We again have in the Q2 reporting season pretty healthy beat rates, pretty healthy surprise factors. When we look at AI, we look at tech, once again AI CapEx plans are actually exceeding expectations. Remember, 6 months ago, we've been all very, very worried around DeepSeek, what that means for CapEx plans. And not only in Q1 has that in the S&P 500 exceeded expectations by 10%, we're starting in Q2 once again with that exceeding even higher expectations. So to me, none of that smells like a bubble. It would be a bubble if there was no, if let's say people were to slash these CapEx plans, if we didn't see particularly great earnings beat, if we already saw a big negative impact on margins, on earnings from tariffs. None of that really seems to be the case yet. So with that earnings power behind it, I think the rally can stay for at least through the summer.
That said, Michael Hartnett's point here is that given all the strength that you're talking about, why should central bankers be cutting rates? The idea that even though we are seeing this strength, this resilience, this lack of any kind of pain relative to the tariffs and some of the fears that we've seen heading into this year, we continue to see record highs, and yet we still see central bankers talking about rate cuts. How predicated is the idea of a further melt up on this idea that we are going to get dovish central bankers?
Yeah, look, I would be worried a lot more if, let's say, the 30-year was approaching 5.5%, if the 10-year was already above 4.7%, 4.8%. One of the models that we look at internally is what we call the danger zone when it really starts hitting risk assets, when the level of yields or the increase, the velocity of the change in yields is simply starting to be too much for risk assets to stomach. That sort of level on the 10-year starts at around 470, 475. So, we're a good 35, 40 basis points away from that. If we were already at that level, I would totally agree. I think then I'd be like, you know what, it's a bit tricky, because if indeed we get a bit more hawkishness, yields further up, that indeed would be stoking a little bit of fear on spread valuations, on equity valuations. But we are quite far away from that kind of level. So that's number one. Number two is I think risk assets don't really care as long as the idea of rate cuts keeps being alive. That is totally fine. Do we really do equity investors, do spread investors, do we really care whether they're going to cut in September or whether it's only December? That's probably a rates trade. It's a trade whether you've got the receiver or the payer for September on. Fine. Yeah, if you got some trade on the front end on. But for risk assets overall, particularly with that backup in yield that we had in the last couple of weeks, it doesn't really matter as long as the Fed says, look, down the road in the next 12, 18 months, the next step is going to be a cut. That's totally sufficient for risk assets to rally further.
Max, what does that mean as to how risk assets would react? For example, next Friday we get jobs data. If you start to see some real deterioration in the labor market.
Yeah, look, if we were to see some real deterioration in the labor market, fine. Of course, we could have a little bit of risk off, but bear in mind, I don't think that would be particularly sustained. And I actually would say, even if the Fed on Wednesday, for example, was to sound a little bit more hawkish, again, yeah, fine, maybe the front end goes up a bit and that puts a bit of pressure on valuations. But other than 2, 3, 4% down, I have real trouble both with weakness in the labor market and with a more hawkish Fed, that really changes the picture. Because once again, it's the growth, it's the earnings picture that is really, really solid. And I think that really puts into question that notion of this being a bubble, right? That really, really puts it into question. I think we would need to see proper weakness in the labor market. The unemployment rate going up to like 4.3, 4.4%. That is then where we'd be calling into question the validity of this rally, right? Before that, I think it's just a tiny bit of correction, a pretty healthy correction in this way up in risk assets.
Max, not to put too much weight on his note, but again, part of Michael Hartnett's point was that what we're seeing is central banks globally loosening policy. What we're seeing is governments globally putting stimulus. I mean, just look at Europe and the spending that's going to happen there in terms of the military and defense. Max, what you're describing, to what degree is it a global phenomenon?
It is indeed, yes. I do think, it's Europe and US, it's other jurisdictions as well. And of course, what that means is, it means probably for the foreseeable future, for the next couple of quarters at least, we will continue to have a pretty strong and pretty high nominal growth world. What do you do when there's a higher nominal growth world? And what do you do if perhaps inflation does remain a little bit stickier and does remain a bit higher? What's your ultimate hedge? Well, it's equities, because equities is the one asset class that exposes you to nominal cash flows. It's a nominally growing asset class. So if indeed, yes, we were to see in the next 12, 18 months, perhaps in the US in particular, inflation a little bit higher, I wouldn't be really throwing in the towel, because the counter to no rate cuts, or not as many rate cuts as markets have priced in right now. The counter to that is a continuously strong nominal growth world, which is really good for equities in particular.
I love how much the idea of a bubble seems to have triggered you this morning. It seems like we're trying to put our tinfoil hats on and you're like, this is ridiculous. How could you? I do wonder, though, it goes to this idea of people looking for havens, looking for a ballast in their portfolios, which has also kind of triggered you to think about bonds in that same kind of way. And we saw that in your recent note. What have you found in terms of what the new haven is and how different it is than, say, 5 years ago?
Yeah, look, I think what is different definitely is around the dollar. The dollar probably is no longer that big safe haven. One of the key risks that we are worried about in the second half is perhaps a retightening of the labor market because of immigration flows going into reverse, certainly going the other way from where we were in 2022 and 2023. And that, of course, would lead, perhaps this retightening of labor market would lead to a repricing of rate cut expectations on the one hand, but it would also lead to a negative impact on growth. So that would be the worst of all worlds, where US growth would go down, but we also have a tighter labor market that constrains the Fed. In that environment, the dollar probably doesn't perform as well, because you are going fully into some sort of stagflationary concerns. What performs well there? It's still, things like gold. It's still things like the Swiss franc. Those, I think, particularly on the gold side, where we are really, this is pretty much the only safe haven we are overweight at the moment in our tactical asset allocation views. That still very much reigns supreme, because you have these continued geopolitical risks lurking in the background. You've got perhaps those stagflationary concerns also coming back in the second half. And then the only one really hedging you against that is gold, and perhaps a little bit also the Swissy.
Max Kettner of HSBC, thank you so much. As we do see gold on an absolute tear this year at the expense possibly of the dollar. We're not sure, but there is a sense that maybe we are seeing a haven play there. So interesting. And I'm glad that you really keyed in on Michael Hartnett's note also. I thought it was interesting because it's predicated on this idea that there is this global easing cycle. Right after we got an ECB meeting where they were pretty hawkish, they at least tried to be, and talked about how they're in a pretty good place, almost taking off the prospect of further rate cuts this year.
Yeah, sounding a lot like Fed officials saying that we are in a good place. I think it just goes to show that when there is the risk of inflation volatility, it's really hard to continue with the whole great moderation. That's what it was predicated on. The fact that maybe we got lucky that there weren't supply shocks, that central banks were independent. Those are the two very same narratives that are being tested right now. So it begs the question, do you need more premium for bonds? And if you do need more premium in bond yields, can equities stay where they are right now? It's these big questions that I think has a lot of people nervous to continue riding on this wave of optimism.
We'll be getting into hard hats and construction zones in just a minute. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahaira Anna and Yahaira.
Hi, Lisa. We are staying on hard hats, actually. President Trump put on a hard hat and toured the renovations at the Federal Reserve with Chair Powell. And there was that tense moment when the president claimed the price tag had jumped from $2.5 to over $3 billion. Following the tour, Trump said there wasn't cause to fire Powell, but reiterated his call for the Fed to cut interest rates. Meanwhile, at least $1 billion worth of NVIDIA's top AI chips made it into China in just 3 months, despite U.S. export bans. The Financial Times citing sales contracts, company filings, and saying Chinese distributors sold restricted processors through a black market channel. Washington has since reapproved sales of NVIDIA's H20 chip, which performs below the restricted B200. And LVMH sales fell in the second quarter as demand slumped in Japan and China. Revenue at its fashion division, which includes Louis Vuitton and Dior, tumbled 9%, which was worse than analysts expected, while first half profits slipped 15%. Shares are down more than 25% over the past year. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, agree to disagree.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
A made-for-TV moment in the Fed Reserve's new building. John Lieber of Eurasia Group joins us next. This is Bloomberg Surveillance. Trying to eke out a fifth straight day of gains after 4 record closes, but each of those just inching upwards, as Danny was talking about earlier. Just really somnolent in the markets. Not doing a lot today, although we are seeing a little bit of a pop in the Russell 2000 in the bond space, just creeping a little bit higher on the front end of the yield curve. And frankly, this is a worldwide phenomenon after yesterday's ECB meeting, heading into the Fed's confab next week. Under surveillance this morning, agree to disagree.
We're just taking a look at what's happening. You know, it's a tough construction job. It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
It's part of the overall work.
So, it's not new.
Well, I'd love him to lower interest rates. But other than that, what can I tell you?
Here's the latest. President Trump continued questioning the cost of the central bank's renovation in a rather awkward exchange with Fed Chair Powell. Trump also reiterating his belief that the Fed should lower interest rates. Bloomberg's Mike Shepard joins us now. Mike, other than having sort of an awkward marital spat over renovations, what did we learn yesterday?
Well, we actually saw the president try to lower the temperature a bit on this question of whether he would or would not proceed with trying to dismiss Jerome Powell as Fed chair. After the tour, and despite that tense moment with the Fed chief, he indicated, look, that the building doesn't really rate quite as what some in his administration have considered to be a firing offense. We even saw Jay Powell take issue with the president's number there right in front of the press. And that's not usually the kind of challenge that Donald Trump takes kindly to, but he took it in stride. And then afterward, again, addressing reporters, really made clear that he just wanted one thing, Lisa, and that is he simply wants interest rates cut. And this has become a central theme of his economic message. In addition to tariffs, in addition to tax cuts, he wants to see rates come down for the sake of home buyers and businesses. And he tried to make that call pretty clear yesterday during this visit.
The whole flood the zone type of approach where you throw a lot of things into the same ball. Bloomberg's Mike Shepard, thank you so much. As always, joining us now, John Lieber of Eurasia Group. John, the fact that we did see a conflating of these two ideas, first of all, taking issue with exactly what the renovation costs were, but then just lower interest rates. How unusual is this, and why are markets still continually shrugging off this sort of unconventional, at least verbal intervention with the central bank?
Yeah, it's definitely unusual. I don't think we've ever seen anything quite like this. I mean, it's pretty clear that at least within the last few weeks, Trump has wanted to fire Powell and is taking the idea really, really seriously. It's the only reason this building is a controversy. It's the only reason the OMB sent the letter, which was accusing Powell of malfeasance, which would have allowed Trump to fire him for cause. But I think what we saw yesterday, we can call it the Eccles building truce, because it's clear that Trump's moving on from this idea. I think that Treasury Secretary Scott Bessent and others have really prevailed on him that firing Powell would be very bad for his presidency. He toured the building. Doesn't look like Versailles, despite what he's been told by some other folks. And I think that this issue is largely going to go to rest, and markets are probably right to ignore it for now.
Yeah, really underscoring it's not Versailles, given just the location they were talking in the hard hats. I don't think you'd be wearing that in Versailles. John, what does it mean as to what we expect from President Trump here? Do you truly believe he's moved on from this topic, or is this a president that's going to continually try to jawbone Powell?
No, he's not moving on. He thinks he should have the power to control interest rates. And I think that's one of the big dangers next year after Powell's replacement has been announced is that either you have a Fed chair that's much more open to intervention from the president, or you have markets that believe that the Fed chair is open to intervention from the president. And I think that the key date to watch right now is the next Fed meeting on July 30th. If they don't cut rates then, I think expect this theme to come back up, and Trump's going to tell them that he wants them to lower rates again. But I just don't think he's going to fire him. So I think this is more of a 2026 story. It's more about what happens after Powell. And for the next year or so, we're going to continue to hear Trump talk about this, and you're going to continue to hear markets correctly ignore it.
John, does that mean we're already set up in a scenario that for 2026, whoever the Fed chair is that there's already a loss of credibility, that we're already questioning the political nature and swayability of who comes in next after Powell?
Yeah, I mean, a lot of the clients that we speak with raise this concern that they think whoever Trump ends up choosing is going to be someone who's told him behind the scenes that he's willing to do the stuff Trump wants, which is cutting interest rates at a time the data doesn't support it. So I think that's a credibility challenge for the next Fed chair. It means that they're going to have to take additional steps in order to anchor inflation expectations. This could mean that they have to raise rates, and that could risk when they wouldn't otherwise. That could risk Trump's ire in that situation, or you just have markets who don't believe that the Fed chair is going to do what they say they're going to do. So this is a huge problem for next year. One factor that I think matters a lot is that whoever the chair is going to have to find a majority on the board. So it makes it very much more difficult for the president to put somebody in who's purely pliable, because rates are subject to a vote of the FOMC, and that is going to make it harder for a pure Trump loyalist to get his or her will as chair on the board.
I can just imagine an investor listening to this conversation and saying, you guys are still worried about this because we've moved on. We've stopped looking at the potential conflict of interest at the Federal Reserve. Yes, this is an unconventional president, but we're looking at the idea that we've got tariff agreements, that we have the one big beautiful bill. And frankly, we feel pretty good to keep propping up equity valuations. Have we gotten some certainty, even as there is this very unconventional approach to the Federal Reserve that largely the market is kind of shrugging off?
Absolutely. I mean, I think that the August 1st deadline is relevant because we'll know where the tariff rates are going to end up landing for most U.S. trading partners. It looks like the U.S. and China are headed towards a summit later this year. And the only way that's possible is if you get agreement around where the Chinese tariffs are. And so I think that a lot of the uncertainty that was prevalent earlier in the year is really being washed out of the system right now as the world is getting used to the United States having a roughly 15% average tariffs, which is a massive increase from where they were at this time last year, yet the markets don't seem all that bothered by it. So I do think going forward, that even with the headwinds and the frictions of higher tariffs, you have a lot more certainty, and that's probably good news going into the rest of the year. The question, however, is going to be, when does the economic data start showing inflation or the effects of Trump's immigration policy? We haven't really seen that yet. It may not come, but it does feel like if you just look at this from the pure policy perspective, there's another shoe that could drop here.
How much are clients taking at face value some of these deals? The idea that these are the rates that are going to stick?
I think for the most part, these are seen as credible. I think that the Trump administration has been very clear in its messaging that it doesn't want to be litigating tariffs in the second half of the year. Scott Bessent said over and over again that he wants these deals to be done by Labor Day. And I think that even if there's some, you might see one of the challenges here, I guess, is that the purchase agreements may not come through. Trump might retaliate with higher rates, but the deals that are being agreed to are the deals that they think are going to stick. And I think that's probably right.
Lieber of Eurasia Group, thank you so much. And this does seem to be what people are focusing on much more than concerns around the Fed, because evidently you say something enough and the market just becomes numb.
Yeah, and you announce 15 baseline tariffs instead of 10 and you hit all-time highs. I think it might underscore that August 1st maybe isn't the big scary deadline for markets that we once thought it would be.
It might be the big scary deadline, though, for Volkswagen and for Puma, and we'll be talking about that in just a minute. Coming up, though, we'll be talking with Jason Thomas of Carlyle ahead of more Magnificent Seven earnings next week, really driving the optimism amid this AI capex boom. Plus, Yahira Anand with your morning movers as Intel falls on turnaround concerns as they don't promise the same kind of growth tied to the foundry. 4 straight days of record highs at the close, although each of these record highs, just to give you a sense of the incredible zest underneath it, yesterday's record high was up 0.07 for the S&P 500. Meanwhile, if you take a look across the board this morning, not doing anything as it hasn't been for quite a while. The Russell 2000 getting a little heat, up 0.2%. What you can see in the bond space is interesting, especially after yesterday. At the front end, a bit higher. At the long end, a bit higher as people price in the idea that maybe central banks globally will remain on hold. 2-year, 10-year, 30-year, across the curve, across the globe, inching ever higher with 30-year German bond yields at the highest levels since 2011. 3 hours away from the cash open, here is your Morning Movers with Yahira Anand. Yahira.
Hi, Lisa. Build it and they will come is no longer the strategy over at Intel. Take a look at shares. They are down 7.3% after its new CEO, Lip Bouton, said he was scrapping major factory projects and called spending at the company excessive as it tried to revive its foundry business. But investors apparently not sold on this vision. And they also did not like that Intel guided lower on margins and that it didn't give a clear path when it came to competing in AI. Next up, we have shares of Paramount. They are rising 1.7% after the FCC approved its merger with Skydance in a deal mired in controversy. Just a week ago, we were talking about how Paramount canceled Stephen Colbert's show, with some thinking that it did this in order to get this deal over the finish line. But whatever you think about that, the deal is done, and Sherry Redstone, whose family has run this company for decades, will be stepping down from the board upon its completion, and David Ellison will become chairman and CEO. That is some succession-level drama. And we end with Deckers. It had a blowout quarter. Shares are up 13%. This is the company behind Uggs and Hoka sneakers. Sales jumped double digits for both brands, but it's not all smooth sailing from here because this is a shoemaker. So, of course, it is heavily impacted by tariffs. And while it was mostly able to avoid that by front-loading shipments, Deckers is warning that price hikes may be coming as those costs start to catch up to it. Lisa?
Thank you so much, Yahira. So interesting to watch the retailers as they adjust to the potential tariffs. On our radar this morning, there is only one story. It has hard hats and is made for television. President Donald Trump downplaying his feud with Fed Chair Jay Powell after touring the central bank's renovation project, despite some moments of tension.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
Well, I'd love him to lower interest rates. But other than that, what can I tell you?
We're going to play this over and over again today because it really is quite something. And I've got to say, Danny, it leaves me with this impression that it did feel a bit like two people arguing in a sort of congenial way about something that we all have argued about, home projects, given the fact that there tend to be some issues that come up.
Well, I mean, kind of the hilariousness of this was that the Fed worked so hard to try to dispel the issues with the building, putting out memos, changing their website. Literally all it took was for the two of them to get together, put on their silly little hard hats, slap each other on the back and laugh. And afterwards, you have Trump tweeting out, it is what it is. Our country can handle the high costs. I thought another little amusing detail was the Wall Street Journal. They're reporting they got a tour from various Fed officials of the building. Apparently, there's an oval entryway. And before Trump had come, they wrote on it the Oval Office. They thought it'd be a funny joke. But then they spray painted over it because they were scared they were going to anger Trump. These are federal officials who were so nervous. And then you get this really jokey attitude once they're both there.
Yeah, let's see how nice that attitude will be, though, next week if they do not cut rates on Wednesday. That will be the Fed meeting, and we are expecting them to hold rates steady, although with two potential descents. Meanwhile, real question of what the outlook is going to be, not just for U.S. companies, but globally. Volkswagen lowering its financial outlook for the year, citing the escalating cost of President Donald Trump's tariffs. The company's CFO telling us here at Bloomberg, quote, "We need a good compromise." It felt like the tone at European companies a little different than those in the U.S.
And especially when you think about what just happened in Japan. With the trade deal there, with getting car tariffs, those sectoral tariffs down to 15% for them, Toyota goes off to the races. But of course, one of the big differences is Toyota makes some $60 billion worth of cars in the U.S. Volkswagen isn't doing this. And I thought Matt Miller had a really good point earlier this morning that you could say, hey, Porsche should start opening a U.S. factory and making cars here, but no one wants to buy a Porsche 911 built in the U.S. The whole point of them is that they're luxury cars. You buy them in Stuttgart. So how much can Volkswagen really shift over to the U.S. anyway?
That feels like a very personal point from Matt Miller. That's all I can say.
None of us are buying 911s.
Exactly. None of us are actually buying 911s or going to Stuttgart to view the different models, although some of us, I assume, are. Meanwhile, looking at this story, and this is something Yahaira was just talking about, Intel CEO failing to convince investors that the company's turnaround plan is still on track. The chipmaker reporting an upbeat revenue forecast, but adding the company will cancel some factory projects and take a more conservative approach to spending. Those shares lower by 7.3% in pre-market trading. And they also talked about some serious job cuts.
Serious job cuts. Spending is going to be reined in, really in opposition to what we're hearing from all the other big tech. And I know that this is a very Intel-specific story, but I wonder if you can look at it and say, look, you have all of these companies spending so much in capital expenditures. We know CapEx cycles are boom and bust. What if more companies start going the way of Intel? Are we now developing this really fat set of distributions from the spending that we're getting? And if more companies need to cut back, does it hurt that much more? Again, I know Intel has its own problems, but could it suggest something that might come down the road for others?
It also speaks to the winners and the losers in the tech stack, and the idea that Intel possibly delivered better than expected earnings from bringing forward demand ahead of tariffs, but doesn't have a growth strategy, and frankly is still hinged on the PC world that is undergoing a lot of transformation and doesn't have a sense of promise for the future. And that really goes to the question of how much are people looking way beyond these current earnings to what is your forward-looking dream, the dream of AI, the dream of agents, the dream of technology to back it up in terms of energy and other infrastructure.
That's why I don't know is not a good enough answer for a lot of these companies. A chip maker earlier in the week said, we don't know how much of our sales were a pull forward. We have 100,000 customers. We don't know. Markets didn't like that because they want to know. They want to know that what we're seeing now, and I think across the board, isn't just that pull forward and you have a plan in place.
Let's stay with this, the idea of CapEx and what this means for some of the big tech earnings. We get more Mag 7 earnings next week, and we are going to see potentially if some of those AI investments are paying off. Jason Thomas of Carlyle writing, the job displacement, productivity gains, and agentic economy expected to upend our world have yet to materialize. The current AI-related CapEx already accounts for more than 1/3 of the second quarter 2025 U.S. economic growth. Jason joins us now. Jason, always wonderful to speak with you. Thank you for being with us. And to me, this is the big question that so many people have underestimated for 2025. How much are we actually seeing that AI tailwind come into practical effect versus still remain a promise?
Well, I think it's interesting because when you think of AI, when you discuss AI, it's almost exclusively about the future and what it means. And that, I think, distracts from the present, just how important all this spending is. Stacks, servers, GPUs, physical construction, and of course, electricity, related energy needs, related applications. And this, you have 4 companies now that are intending to spend over $300 billion this year. About 6 are spending over $400 billion. This went from something that is market significant, stock market significant, to something that is now GDP significant. And also, I think, underappreciated. It's also increasingly significant for bond markets. Because, if we look a decade ago, these large companies, they were largely virtual companies. Prior to the pandemic, this class of businesses, only about 20% of their book value was property, plant, and equipment. Most of it was really just cash, security holdings. Now, property, plant, and equipment accounts for over 70% of their book value. There's an industrial feel to some of these businesses as they ramp up their capital spending, and that huge surpluses that they used to generate, that providing liquidity to the rest of the economy, is now being rolled into to capital spending AI.
So, Jason, just to sort of bleed through into the market, what you're saying, the industrial revolution that so many people say is taking place, are you saying that is the physical world sucking capital out of financial markets, in particular the bond market, leading to higher yields?
Exactly. Again, what's so interesting, I think, is that these companies have really exercised an option to change strategy. In the past, it was typical to generate $100 billion of cash from operations, reinvest maybe $12 to $15 billion, and then that free cash flow would, of course, lead to a massive war chest on the balance sheet, or it would fund huge share repurchase programs or special dividends. Today, that revenue is being diverted to CapEx. And so this raises really interesting questions, such as the cash generation potential. We saw in Alphabet's earnings a big divergence between net income and free cash flow. It also raises industrial era questions about capacity utilization. And also, what is the economic rate at which this new capital depreciates? Is there functional obsolescence when you're investing at the frontier of new technology? How quickly does it arrive? So these are, again, very interesting questions. But from the bond market perspective, when you look at the cumulative cash flow surplus of the corporate sector this cycle, it's down 75% from where it was a decade ago. So the last cycle, there's a question, very large deficits. Why was it so easy for the Fed to fund itself? Well, of course, QE is the simple answer. But I think behind that, you also had, again, this enormous corporate savings glut. Some of that was cyclical, the scars from the GFC. But a lot of it was that most of the growth in earnings and revenues were attributed to, again, these virtual businesses that could grow revenue without incremental hiring, incremental investment. And they've changed strategy.
So, Jason, it's some serious tailwinds and changes we're talking about. But as you underscored, it's only a handful of companies. It's only 4, maybe 6 companies, hyperscalers, that are leading this charge. Is there a concentration risk in this, that these trends are being driven by a small cohort that for now are being rewarded by markets for spending? What happens if that changes?
Yes, of course, there's concentration risk. There's concentration risk in the stock market. There's concentration risk in the economy. Again, as capital spending and GDP become more dependent on these continued outlays. And I think that people talk about the Mag 7, of course, and it's the share, I think, 15% of global stock market capitalization, almost a third of the S&P 500 market capitalization. But I think that what's more concerning, to me at least, is that these are not a diversified set of businesses operating in completely different sectors with completely different strategies. They're all basically pursuing the same end goal at the moment. There's some variation, of course, but in general, it's a concentrated bet on the same AI future. And everyone has to hope that ultimately it pays off, because again, it's not just of significance for the stock market or investors in these particular companies, but again, it has very significant spillovers on the rest of the economy today as well.
Well, some of those spillovers, Jason, which has been widely talked about, is what it does to this labor market. And there it's unclear what's really showing up. You see it in some of the earnings. ServiceNow, the management platform tool, the CEO there saying yesterday, we're slowing down the hiring in jobs that are, quite frankly, soul-crushing, which I think is maybe a nice way to describe replacing people's jobs with AI. Jason, is it showing up anywhere?
I think that most of the change in the labor market that we observed in 2025 was related to tariffs, just the shock, the uncertainty. And I think what was so interesting about that was CEOs really not panicking. After April 2nd, I think there was this intention to project a sense of normalcy, to look at competitors and see if there were any missteps, if they could take market share. And part of that had been, yes, perhaps slowing the pace of hiring. But it was just interesting when we look through our portfolio that there really not much of a reduction in open but unfilled positions. There really wasn't the pullback that I think many people expected. So the labor market has held up reasonably well. And of course, on the other side of that, you have inflation. That continues. If you look at core PCE over the last 12 months, still probably 2.6%. So, it is this interesting moment where I think that inflation's a bit stickier. I mean, of course, some people look at the last 8 to 10 weeks and tell me inflation is only up by 1% annualized rate. But, of course, there's not that many prices in our economy that reset that regularly, whether they're fixed for contractual term or just other frictions. So it's a 12-month inflation benchmark, and it's still elevated. So, next week, I think, is a time when the Fed is very reasonably going to keep rates steady.
Jason, you're making an argument for why stocks can outperform and bonds cannot. The idea that the promise of the future and all of this investment and the profitability is much more attractive than credit markets that people say, or I would say government bond markets. Credit markets might be slightly different. Is that accurate? Is that kind of the way you think of the world right now?
There is, of course, the convex upside of earnings, of the potential of AI. And that is what equity markets are ultimately betting on. Whether that materializes or not is a separate question. But there is that upside there. And I think also just the potential for inflation. When you have businesses that can increase prices proportional to the overall increase in the price level, that also provides an inflation hedge when you're investing in businesses. The fixed income markets, that's a different story. Right now, if you look at the size of the U.S. fiscal deficit, it's consuming about 40% of the savings of the private sector. That is the savings of the household sector plus the free cash flow of the corporate sector. This is up about 50% from where it was in the past cycle, the 2009 to 2019. So this is just enormous funding needs. And I think that people have to be concerned about the potential to be inflated away. Eventually, the Treasury may try to term out more of its debt issuance. And what is the market clearing price when the share of federal funding actually moves in the direction of 10-year notes, 30-year bonds? So I think certainly a lot of questions there. And I think the other big concern, bonds historically have hedged equity market risk. That was the experience really since 2000. What we've seen since the Fed started hiking rates in 2002 is that stock and bond returns have been positively correlated. Right. So those Treasury holdings that you thought were protecting you, that would rise predictably when stocks sell off, are actually selling off at the same time. And we saw that, of course, in April, which many people attribute to the decision to suspend the initial Liberation Day tariff schedule.
Jason Thomas of Carlyle, thank you so much. A lot to think about and really insightful comments there. We really appreciate you joining us. Right now, let's get you an update on stories elsewhere. Here are your Bloomberg Brief stories with Yahira Anand. Yahira.
Hi, Lisa. Israel and the U.S. are withdrawing teams from ceasefire negotiations with Hamas, citing the group's unwillingness to agree to terms. President Trump's envoy Steve Witkoff said Hamas showed a lack of desire to end the war. Israeli Prime Minister Benjamin Netanyahu said any deal must include Hamas surrendering and giving up control of Gaza. Sticking with the Middle East, French President Emmanuel Macron says France will officially recognize a Palestinian state, becoming the first G7 nation to do so. Macron says France remains committed to, quote, just and durable peace, while calling for an urgent ceasefire. U.S. Secretary of State Marco Rubio criticized the move, stating in a post that it sets back peace. And shares of Puma are plunging 17.6% in German trading. The company slashed its profit forecast in the face of weak demand for its sports and exercise gear amid growing concerns about the impact of U.S. tariffs. This is the third major rout this year for the company. Shares are down over 50% so far this year. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, bumpy airline earnings.
Business demand dropped off at the start of the year. That seems like it's bounced back to what we were expecting it to be. Premium and higher end leisure sort of stayed consistent throughout it. The biggest impact for the consumer was in low end leisure.
Tom Fitzgerald of TD Cowen joining us next. This is Bloomberg Surveillance. Stocks looking for direction ahead of a huge week. A lot of people parsing through myriad earnings we've gotten, particularly from the travel and leisure sector. Under surveillance this morning, bumpy airline earnings.
Business demand dropped off at the start of the year. That seems like it's bounced back to what we were expecting it to be. Premium and higher end leisure sort of stayed consistent throughout. It never really dropped off. And the biggest impact for the consumer was in low end leisure. And that's come back some in July, but not as much.
Here's the latest. Mixed results from airlines. American and Southwest cutting their outlooks for the full year as Delta and United reinstate their full year guidance. Joining us now is Tom Fitzgerald of TD Cowen. Tom, what's your takeaway after the earnings we've gotten so far about the tale of two halves when it comes to airlines?
I think we're seeing some green shoots among airlines that have diverse revenues and airlines that are more exposed to premium travel, corporate travel, and long-haul international. Even with American, they did have much better results than Southwest reported yesterday, and I think it's because of exposure to revenue streams like that. And I think I don't think the airlines, whether it's Southwest or the other low-cost carriers that have yet to report, I don't think they're out of the woods yet, so to speak, in terms of the volatility we've seen in 2025.
Tom, what do you do with something like American when they give you an estimate going forward for earnings that's as low as a loss of 20 cents or as high as 80 cents a share? What do you do with a gulf like that?
Yeah, it is a wide range, but it's the airline industry. It wasn't, I think part of the problem was sell-side estimates were broadly too high. I mean, a lot of what they guided was pretty close to where our numbers were. So I don't know if it's maybe the outlook isn't as bad as the gap between what was guided and what people saw in their Bloomberg or fact sets yesterday.
Well, still, you noted that the ones that are doing better have their premium travel, and we've seen airlines invest more into premium travel, expand the seating there, for example. But it's an industry that sometimes is bad at looking beyond the moment. We learned that in the bounce back from COVID when they were unprepared for it. Tom, what is the risk that airlines are investing into premium as we might be hitting a precipice where consumers start to pull back on spending?
That's definitely a risk for sure. I think there's also a chance that maybe we see some reacceleration at the, or at least among higher income cohorts, whether it's, the reconciliation bill that was passed recently, or, there's potential for Fed cuts in 2026 or even the second half of this year. That's positive for risk assets. I remember back in April, there was concern about with the stock market having fallen so much that you'd see this negative wealth effect, and that would flow through into premium traffic demand. So I think you could see the reverse and see a positive flywheel effect from here.
Tom, how much do we see the airlines that cater to wealthier individuals doing better, and that's just going to be the path of travel going forward?
I think so. And I think if you look at their dominant share in positions or cities like New York or Los Angeles, it's not like these are easy markets to get in and out of, even though the assets, the planes are mobile, getting into the right markets and having the right fleet to service the ideal demand, that takes years in advance. And it's like turning an aircraft carrier. United didn't get here overnight.
Tom Fitzgerald of TD Cowen, thank you so much for your time. I've got to say, I honestly, Danny, see some of these airlines and they're like, look at our premium offerings. It's amazing. You have seats that massage you while they go back and then paint your nails. And then don't look at the back of the cab because you know what? Whatever. Who cares? That seems to be the path
but
of travel.
They've got us all hooked on, I guess, the free manicures or whatever. So now when people travel, they're like, I need to pay up for it. I experienced the good life and I'm not going back.
Well, but it's just so interesting because you can tell a different story about the consumer if you look at Delta or if you look at Southwest. Delta, totally solid, coming back, business traveler coming back, people still looking for that front first class type of seat. But if you take a look at Southwest, it paints a very different picture of the American consumer.
It does, but I have to say, it feels like it is an industry that is so sensitive to consumers to the point where Delta talked about using AI in its pricing. And you got all these airlines pushing back. American Air, the executives came out saying this is going to erode customer trust. It's a bait and switch if you use AI to do pricing. I mean, they were already doing dynamic pricing. I'm not sure how much it changes things, but you just get this sense that they are being so careful if it is a consumer being more picky now.
Yeah, I do want AI to give me therapy during travel, and I think that they're working on that. Coming up next, Alicia Levine of BNY Wealth, Krishna Guha of Evercore, Francisco Blanch of Bank of America, and Chen Zhao of Redfin. This is Bloomberg Surveillance.
We have yet to see the actual effect of tariffs.
15% is the new 10%, 10% is the new 0%.
It's still possible to believe that these tariff rates are still only going to be temporary.
Markets have correctly assessed the tariff situation as benign at the end of the day.
The bigger picture, I think, is the market's coming around to is less about the tariff and it's more about how the new era of globalization comes to fruition.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Heading into a massive week of earnings, 38% of the S&P 500 stocks inching up to new record highs for 4 straight consecutive sessions, and a big Fed rate decision with key economic data ahead. John and Annmarie are off today, but I am so happy to say Danny Berger is alongside me today. And Danny, it seems like people are looking past the noise with the Fed, as much as the hard hats are interesting. They're looking past the noise with tariffs and looking straight to corporate America that is ascendant.
82% of the companies we've heard so far have beat on earnings expectations. Yeah, a lot has been said about the bar being low, but in some ways, the bar isn't low. It's a stock at all-time highs. And we look at that and we get confidence. The confidence maybe just slightly kneecapped by the fact it's just inching up higher. 22 sessions so far without a gain or loss of more than 1%. That is the longest stretch since October of last year.
So next week, we've got three parts. We have the earnings part with Magnificent Seven coming out, a massive slate to just finish up what we heard from this week. We have the Fed decision on Wednesday. Watch Truth Social for President Donald Trump and his response to what likely will be a hold. And then we've got economic data. What are you watching most closely?
I want to see if this market reacts to economic data, because it's not reacting to trade disputes. It's reacting positively to earnings. That story seems to be continuing on. But if we start to see cracks, if we start to see signs that things like tariffs and lack of confidence is finally starting to hit, is that going to be the thing that jolts this market awake, that gets us to move up or down more than 1%? Because at the moment, things like an August 1st trade deadline really are not registering.
In some ways, people are looking more at the corporate earnings for some sort of sign of how the consumer is managing through some of these tariffs. And I find it fascinating to see an increasing divergence between what we see in Europe with the likes of Volkswagen and Puma versus what we see in the United States with the likes of Alphabet, as well as a host of other even retailers coming out with relative strength.
Yeah, a lot of strength, despite the fact people thought that maybe some consumers would start to pull back. But the unevenness, as we were just talking about, even is within industries. You see airlines, some doing better than others. Within the food and beverage space, you see Chipotle doing poorly, but then you see Domino's doing well. It's a lot of haves and have-nots right now, and it's a picture that's increasingly complicated that hopefully we'll get some sort of signal from as the next week progresses on.
Did you get the free burritos?
I didn't get the free burritos.
I heard that they had free burritos, free roast chicken, or
completely
fried
missed out on that.
They didn't really.
Food tastes better when it's free, so I'm upset I missed out.
Well, I think a lot of people did, and that's part of the problem. Right now, you're seeing markets fluctuate, although maybe going to head toward a fifth straight record close. We are seeing the S&P futures gain about 0.1%. Meanwhile, you do see yields higher across the world as central bankers maybe aren't going to cut rates as much as maybe President Trump would like. And you are seeing a little bit of dollar strength following better than expected data yesterday coming out of the jobs market. Coming up this hour, Alicia Levine of BNY Wealth following yet another record high. Krishna Guha of Evercore as President Trump visits the Fed with a hard hat, and Chen Zhao of Redfin on the softening U.S. housing market. We begin this hour with stocks on a 4-day winning streak. Alicia Levine of BNY Wealth writing, the pain trade is higher as the market shrugs off lingering tail risks on monetary policy and the labor market. Alicia, I am so pleased to say, joins us now. Alicia, great to see you as always. The pain trade higher despite the fact that they're the likes of Michael Hartnett of Bank of America warning about bubbles.
Yeah, no, look, I think it's true. I mean, it's not hard to go into a room of economists or bond traders who are extremely negative, and yet at the same time, we see markets marching higher. And I think that's because, you know, if you think about, let's go to the Wayback Machine of April 2nd to April 8th, the worst case scenario was pretty much priced in at over 3 trading days. We were down almost 20%, which essentially is telling you a recession is very close to happening. And to your point, the market has pretty much gone to sleep on the tariffs, whether it's 10% or 15%. And I think we're going to have to revisit that one day. But for now, we're in a place where whatever happens with the tariffs, whether it's August 1st or not, there's a lot of, the sky is falling, but the market's not seeing it this way. And ultimately, the resilience of the U.S. corporate sector, which we're not going to call it American exceptionalism, we will call it American dominance. If you think about what's going on in the European earnings this morning, is just showing you that the earnings are coming through. So what do we see? Earnings came down dramatically April, May, and even to June for 2025, 2026. And then in the last month, we've seen a stabilization and a tick upward. And once those earnings expectations start ticking upward, it pulls the market higher. And this, because in the end, a price on the S&P is a multiple times earnings. We've done the multiple part. We went from 18 times to 22 times forward earnings as earnings fell. And now we're going to get higher earnings going into 26.
Is it American exceptionalism? Or is it American dominance, or is it tech dominance? And that's why you're seeing the sort of division between the haves and the have-nots, even within the United States and the corporate world, with those who are actually implementing true technology solutions versus those that are a bit behind.
So I'd say it is about tech, and I think it's something to keep an eye on. The question of whether, the CapEx spend, so Google spending another $10 billion on CapEx, et cetera, whether that goes into earnings and ROE, right? And that's the big question out there. I think for the market, that question must be answered in the positive. Otherwise, there is risk in the S&P here, because if you do communication services, tech, and let's even say financials, you're at 53% of the S&P. Those are growth. Those are highly growth, a very friendly market for financials as well. So yes, it is about tech. But we can't ignore it. We can't say, well, it's all about tech, so it doesn't matter. I mean, it does matter, right? And that's what's been driving the markets really for the last decade, the last 15 years, is that kind of dominance. The other parts of the world, when you look at other markets, you just don't have the same exposure to technology. And as a result, you're in a tech moment. It's the same trade as it was before COVID. It's the same trade as it was after COVID. We had a little pause, but it's the dominance of these companies. The free cash flow is what's driving their earnings.
Well, one of the interesting things for the tech, and Jason Thomas of Carlyle was on with Lisa and me moments ago, basically saying that these companies have changed. They're not asset light anymore. They're almost industrial players with the amount that they're spending. Just that very fact. Does it mean we need to value these companies different? Because part of their appeal had been that they were very asset light and maybe less exposed to things like rates.
It's actually a really interesting question. I think it's an interesting way of framing it. I don't think you're going to see that yet, but I think what you will probably see is the manufacturing PMI ticking upward as the investment in grid and the investment in energy power starts kicking in, because some of this CapEx is going towards that as well in order to sustain the output, which is AI and juicing, the rest of their businesses. So it's an interesting way of looking at it. But I think that this is going to also help the industrial economy. And don't forget, the multiples are lower than where they were. For most of these companies, the multiples are actually lower today than they were in January, particularly for a Google.
What does that mean for 2026 if you put that headwind together with the one big beautiful bill that gives tax benefits, but also the headwind for tariffs? Are the former enough to outweigh that to produce more growth?
So the number-wise, it is, right? And that's why actually I think it's going to be hard for a next administration to take the tariffs off, and something we actually all have to think about when we do our long-term views and our capital market assumptions going forward, because there is a lot of spend there. I think the excitement over some of the immediate expensing and the way CapEx is treated in the tax bill was not spoken about by corporate America because they needed the bill passed and didn't want to create a political football, if you know what I mean. But I think the results are actually very clear, and I think you're going to see a boom on the industrial side as it's also linked to energy power and growing out the grid. So you're going to have manufacturing and you're going to have grid. That's all industrial. Cyclicals are outperforming now. So it's actually really interesting.
This is way too positive. I'm putting on my tinfoil hat and going under the table and going back to what Michael Hartnett said and reading it over. Oh, my goodness, this is a bubble. And this is going to be on the heels of fiscal largesse, the idea of governments pulling back on regulation. And you have the monetary pressure on the likes of Fed Chair Jay Powell with the hats coming on and, going through the renovations and having a marital dispute. Bigger retail, bigger liquidity, bigger volatility, bigger bubble from Michael Hartnett. Why do you reject that?
It's not that I reject it. I think that there's enough resilience out there to get through it. The risks are real. I think the yield risk is very real. I think the issue of how clients and investors find protection in their portfolio is very real. That's a very real conversation that we're having. How do we hedge the risk with the bonds, and where do we go in the curve here in order to do that? That's very real. I think the conversations are not positive for the bond market. The current conversations that we're having, that's very real as well. I think the spending is difficult. Look, we've sat here and talked about it. The deficit and debt and the inability of Washington to deal with it is a very real thing. As an investor, though, it comes back to the same problem with what do I do with the 10-year? Right? It comes back to the term premium, and we're frightened of it, and where do we invest? So the conversations about the macro all come back to the investing problem. right? And how do you build out a portfolio with that? And that's the task that we face. Like, how do we do that in a world where we know there's risk in inflation and we know that there's risk in bonds?
This is a fascinating discussion. Max Kettner really touched on this earlier this morning from HSBC, saying that they've found that gold is probably the best hedge, maybe the euro to some degree, but not necessarily going to those staple bonds. I just wonder if increasingly, and what I'm hearing from so many different investors is that stocks are safer bet than a lot of government bonds right now because of that prospect for growth, particularly if they're hedged to technological advancement. And bonds aren't going to protect you because the risks are just utterly different this time around.
So we think the risks are there, but we think there's value actually in the belly of the curve, the 5 to 7 years. So that's where we would go. I think the traditional go out to 10 years, that's a different conversation. And our clients are actually very sophisticated and understand this because they have businesses in the real economy and they understand borrowing and what it means. So we do that. We do think commodities are a good hedge here as well. Alternatives as well. I mean, this is where alternatives come into the portfolio as a way, non-correlated to stocks and bonds, to hedge some of those issues out there. In the end, when the entire world and Bloomberg talks about #Liz Truss moment, it's probably not going to happen because it's there, but it doesn't mean it's gone forever. And I think that some of the issues out there are clearly lurking. So we have to be aware of that, right? We have to be aware of that. I think we also have to be aware that the lower quartile of the income scale has been suffering with higher rates. That's very true. I think that's why you see the political pressure coming on. These are people who live short, right? They borrow short. And so they pay rent, they don't own homes, they don't have the benefits of financial assets. So that's something to be aware of as well. I mean, that is a risk too.
Alicia Levine, always a pleasure having you on the show. Thank you so much for being with us. Alicia Levine of BNY Wealth here this morning. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. We start with the check on Intel shares. They are down 8% in the pre-market as investors react to comments from CEO Lip Bhutan, who sparked concerns that he was more focused on cost-cutting than restoring the chipmaker's technological edge. As for the scorecard, second quarter earnings missed analyst estimates, but they did give an upbeat third quarter sales forecast. Meanwhile, Paramount shares are rising 1.5% in the pre-market after the FCC approved its merger with Skydance. The decision ends a years-long saga that included settling a lawsuit with President Trump, as well as concessions on diversity initiatives and news judgment. And pro wrestling legend Hulk Hogan died yesterday following a series of medical issues. Hogan, whose real name was Terry Bollea, began his wrestling career in Florida in the 1970s and became a megastar in the 80s with the rise of the WWE Federation. He went on to star in the reality show Hogan Knows Best in 2005 with his wife and 2 kids. Hogan was 71. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, agree to disagree.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Krishna Guha of Evercore joining us next. This is Bloomberg Surveillance. Futures building on 4 straight days of gains. S&P futures marginally higher this morning, up 0.1%. Nasdaq futures were lower, just fluctuating here. And Russell 2000 up 0.2%. That optimism is being baked into bond markets as well. Yields higher as people ratchet back expectations for how much central bankers are going to have to cut rates ahead. Under surveillance this morning, agree to disagree.
We're just taking a look at what's happening. It's a tough construction job. It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
It's part of the overall work. So, well, I'd love him to lower interest rates. But other than that, what can I tell you?
Here's the latest. President Donald Trump and Federal Reserve Chair Jay Powell disagreeing over the cost of the central bank's renovations. Trump continuing his call for lower interest rates ahead of the Fed's meeting next week. Bloomberg's Mike Shepard joins us now. Shep, how much are we seeing the sea change actually shift in the White House to seeing Jay Powell as something of an asset, a punching bag, if you will, ahead of what might be a volatile fall?
Well, it certainly is a sea change, Lisa, from when the president first appointed Jay Powell to the job all the way back in 2017. And he really hailed him as somebody who would be an excellent steward of the economy. Of course, that message has changed and evolved. Even during his first term as president, Donald Trump began questioning whether he had made the right choice, expressing misgivings over what he saw as Powell's reluctance to cut interest rates at the time. That tune has not really changed from Donald Trump, even in his second term. And what we've seen the president do is escalate that message publicly and in so many different fronts, too. This is part of his strategy of flooding the zone. Not only has he visited the Fed and really called the Fed chair out over interest rate policy, he's challenged the Fed chair over mundane matters like the renovation project on the Fed's headquarters, alleging that it is rife with cost overruns, and some of his allies and the president himself have wondered whether maybe that could be cause for removing him. It's come amid this call by the president for Powell and the central bank to cut interest rates. They're not expected to do so at the meeting coming up next week, but before year's end, we may see 2 cuts by the central bank when it comes to its benchmark lending rate. And Trump's pressure campaign works for the president on a couple of different levels. One, once the Fed actually acts and reduces interest rates, it gives him room to claim victory for doing so, for pressuring the Fed into acting. 2, it also sets the Fed up potentially to become a scapegoat. Should Trump's tariffs and debt-inducing tax cut law actually inflict some harm in the economy, the Fed could be set up perhaps as the fall guy in this case. And then third, it actually sends a message to whoever succeeds Jerome Powell as Fed chair. Remember, his term expires in May of next year, and the person who succeeds Powell in that job will have one mission, if you take it from the president's word himself. It will be to cut, baby, cut when it comes to interest rates, Lisa.
Mike Shepard of Bloomberg, thank you so much, as always. Joining us now to continue the conversation is Krishna Guha of Evercore. Krishna, how much does this really complicate the decision on Wednesday for the Federal Reserve and how they message it, considering that there'll be a real-time commentary coming from Truth Social?
Well, it certainly doesn't make their life easier. I think we already know that Waller and Bowman, both of whom were appointed by President Trump in his first term, are likely to dissent next week in favor of an immediate rate cut. That's not going to have any effect at all on what the Fed actually does. They will, of course, not cut rates next week. But it's a sign of the pressures on the FOMC. I think the question really is, of course, around the September meeting. At the end of the summer, will the Fed cut or not cut at that meeting? I think Trump is trying to build pressure to try to make sure that they do move ahead with a cut then. I think that is very likely penciled in as the base case plan, but it is in Powell's mind data dependent, depending on what they learn over the summer.
Krishna, it begs the question, if the next Fed chair that's appointed is someone who leans much more dovish, that wants to cut rates as Trump wants to cut rates, does it matter if that's already the direction of travel?
Well, sure it matters because, the question is, not simply is the Fed cutting rates, but by how much? And is that cutting proportionate, reasonable, relative to what we're learning about the condition of the economy? If it is, market's going to be just fine with that. But if it looks like the next Fed chair is cutting a lot more aggressively than economic conditions warrant, then you're in trouble. That's when you'd see inflation expectations moving up. That's when you'd see yields moving higher, the yield curve steepening, all things, by the way, that I don't think the president actually wants to see.
Right. So firing Powell or trying to replace him with someone hyper dovish would be counter to what this White House wants. Krishna, there are other methods, though, to change the makeup or at least change what the Fed does. In the 70s, we saw this, a mandate to include a dual mandate to focus on inflation alongside the labor market. This is a Congress that has been pushing Trump's bills through. Is this a risk? Could they re-look at the Fed and try to make them and reshape them in a more populist image?
So I don't think we should rule anything out right now. Up to this point, though, the Congress, specifically the Senate, has taken quite a sober and traditional approach to the Fed. You have not seen, Senate majorities, trying to censure Powell or do anything else to undermine Fed independence. In fact, quite the opposite. You've seen a number of Republican as well as Democratic senators emphasizing that an independent Fed is in the national interest. And what I would say is if there were to be any reform of the Fed's mandate, the traditional Republican line is that you should get rid of the labor side, focus only on inflation. But that's exactly the opposite of what the president wants right now.
Krishna, does the president have a point, though, when it comes to lowering interest rates to benefit lower income individuals in particular? And maybe this isn't something that the president has expressed, but a number of investors have, which is that the lower income cohort is struggling. They're the ones that tend to borrow short when it comes to credit card bills, when it comes to auto loans, and they're less sort of benefited by the other aspects of the economy that are doing really well. What's your argument against that?
So I think it is a very fair observation, and to the extent that that's what's motivating the president, I would very much respect that concern for low-income folks. But here's the problem. The Fed sets one interest rate for the economy. It doesn't get to pick an interest rate for low-income people and an interest rate for high-income people, an interest rate for NVIDIA and an interest rate for the mom-and-pop store. It has to pick one interest rate that in aggregate balances supply and demand in the economy, keeps the economy in a position where underlying inflation is going to settle at 2% when the tariff shock is over. The labor market will stay in balance. It is always and everywhere the case that the interest rate that the Fed is maintaining will be a bit too high for some people, a bit too low for others. But the question is it the right one for the economy as a whole? Because they only get to pick one rate.
Krishna Guha of Evercore, thank you so much. Very much looking forward to the next time you come on. It's a really compelling point. And Danny, this is something that a lot of people have pointed to. How do you create a rate structure for an economy that's increasingly bifurcated?
It's a problem that we've been grappling with for some time. And it's the reason why people are talking about cuts, that sure, on a headline level, the labor market looks okay, but underneath the surface, there are real issues. The problem is that while that conversation is happening, stocks are at an all-time high. Corporate America is doing really well, and elsewhere, the data is holding up. So it is this dichotomy that makes you feel kind of insane talking about cuts right now.
Well, and it's not exactly as if the president is making this argument when he's wearing hard hats, talking about renovation costs and then saying, what you really could do for me is just lower interest rates. It doesn't feel like it's the same kind of cohesive economic argument.
No, it certainly doesn't, but it makes for a really great meme that I'm looking forward to it living on very long in many different forms.
All I can say is that President Trump is the ultimate producer. He creates incredible made-for-TV moments. Coming up, Yahaira Anand with your morning movers as meme stocks mania pushes American Eagle shares higher across the board, accounting for a greater and greater proportion of overall trading volume, even though they comprise just a tiny part of the overall market cap. Looking for a fifth straight day of gains after 4 consecutive record highs at the close for U.S. equity markets. Continuing that feeling right now with futures, S&P futures up about 0.1%, Russell 2000 futures up 0.2%, and bond yields creeping just a touch higher, 2 hours away from the cash open. Here is your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start with American Eagle shares. They are up 1.3% as it becomes the latest name to catch some meme stock momentum. But this time, there's a real catalyst. The company just launched a new campaign with the ultra-popular actress Sydney Sweeney, and it has traders on Wall Street bets buzzing, especially because it has high short interest, which makes it a prime target for these traders. Next up, we have Coursera. Those shares are soaring, up nearly 30% now after a strong quarter. The company blew past revenue estimates in the second quarter, and that's thanks to booming demand for its courses around AI, not just for people like you and me who want to learn to code and learn AI, but also from enterprise customers who want to upskill their labor force. And take a look at Mattel shares. They are rising now 3%, but that is after plunging yesterday on bad results. The company behind Barbie saw sales in its dolls category fall 19%. I guess people really took seriously President Trump's comments that girls just need one doll instead of many. Anyway, Mattel also gave a cautious outlook, just showing you how investors are quick to punish companies that don't guide well. But as I said, a little bit of a give back this morning. Lisa.
Thank you so much, Yahira. Right now on our radar this morning, President Trump downplaying his feud with Fed Chair Jay Powell after touring the central bank's renovation project, despite some moments of tension.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
Well, I'd love him to lower interest rates. But other than that, what can I tell you?
It just really doesn't get old, Danny, each time we watch it.
It is so excellent. I'm sorry. It is really hilarious. I know we're talking about really serious and threatening things like Fed independence, but you know what it kind of reminds me of? It's like when Trump was talking about that he was going to go tour Fort Knox and do an audit and make sure all the gold is there. There was so much noise about that. And then it kind of just petered off. I wonder if this is going to be the same thing, where he gets all this noise about auditing the Fed building. He goes face to face. They kind of have their marital spat. They figure it out, and then he moves on. He even put on Truth Social shortly afterwards that, it is what it is, and we can afford it. It's clear that Powell is his punching bag. He's been able to maintain him, and so maybe we kind of move on just to the occasional tweet, please lower interest rates.
I wish that they had toured Fort Knox and shown us all of the gold there, because that was actually something I was kind of interested in, just on an intellectual level. I do think it does have more import, though, and the idea that next week this does heighten some of the attention to the Fed meeting on Wednesday, when we will be getting a live blog, I'm sure, from the president, and they are likely to hold rates steady, not do what the president wants.
Well, also part of the problem is that now, even regardless of who becomes the Fed chair in 2026, the credibility is already being questioned before we even know who it is. So regardless of that person, are we going to judge inflation expectations that should be higher? Because we think it's someone who's going to come in and cut, again, regardless of who it is.
People's minds are spinning, and so they are just tuning this out. They're not tuning this out. The FCC approving Paramount's merger with Skydance. The chairman saying Skydance vowed to ensure that the new company's programming includes diverse viewpoints from across the political and ideological spectrum. A real question here about whether this was related to some of the recent programming changes and what this means going forward for both of these companies.
And what it means for corporate America, quite frankly, when it comes to things like M&A. Brendan Carr, the FCC chair, very clearly said that the reason that this was approved is because CBS and Skydance made commitments that they would have unbiased journalism and wouldn't establish DEI practices. This is a corporate America that hated Biden policies, that made it so difficult to get deals done. So there's ideological inconsistencies. It was an administration that came in and promised a more light regulatory touch. This isn't it if you're still demanding things from companies.
Yeah, and you really raise a great point. At what point are ideological questions and demands sort of the necessity that companies have to engage with in order to get some of these deals approved? Meanwhile, meme stock mania making a comeback. Traders targeting American Eagle, as we were hearing from Yahira, after the retailer announced a new campaign headlined by actress Sydney Sweeney. Shares of Open Door, GoPro, Krispy Kreme, and Kohl's also seeing a surge this week. All I can say is that pair of jeans and a picture of them, it seems to be the most profitable picture I've ever seen in my life.
I mean, it's like the bro thing has come back to life. One of Palantir executive put out on X a picture of like a Mad Men meme saying, oh, hear me out, Palantir should hire Sydney Sweeney to hawk their products. So it's this weird thing, and people are saying, it's 2021 again. But is it really? Because we don't have the stimulus checks circulating around and people in their basements with all this free time able to trade all these meme stocks. So I just wonder how long lasting it is. If it is long lasting, you get real concerns about the structure and leverage that comes along with some of these YOLO punts. But for now, it's just a little flare up. I think the concerning thing will be if it lasts longer.
I find it fascinating how sophisticated it is, looking at the short interest of particular companies and then saying, actually, we could squeeze this short out. And that's one of the things that people are examining to understand which will be the popular stocks on the Reddit talk chains. Meanwhile, turning to the economy, U.S. new home sales remaining weak in June and sales of previously owned homes falling to a 9-month low, with buyers put off by higher prices and borrowing costs. Bloomberg's Michael McKee joining us now. Mike, a lot of people have pointed to the housing market as being anathema to all of the happy talk that we hear in the rest of the economy. What's going on here?
Well, you know, President Trump, as you mentioned, is arguing for lower interest rates, and it's a sentiment shared by realtors and home builders, even though that's not the entire problem. But mortgage rates are an issue. You mentioned existing home sales at a 9-month low. Actually, they're at a 3.93 million annual rate, and only one other time, 2023, did they finish below 4 million since the National Association of Realtors began tallying these numbers some time ago in 1999. So it is a real problem, and it is the problem that is supposed to be solved by lower interest rates. I was talking with Walt Schmidt, who's a mortgage strategist at FHN Financial, and he said we probably need to get down somewhere below 6%. Somewhere between 5 and 6% might be the magic number that gets people out of their houses. Because right now, everyone is holding on. We know what happened during the financial crisis and after, as the interest rates went to zero from the Fed. Mortgage rates went way, way down. Some people got mortgage rates that begin with a 2. Do you want a 2? You're not going to get it again. But you can see the effective mortgage rate, that's the white line there, is the rate that people are paying on average here for mortgages. And you can see what the rate is today in blue there, and that's the major difference between why we can't get anybody out to buy houses. But home builders will tell you it's not just that. It's also having the land and having the ability to build new homes. And at this point, they're not doing that either. New home side, there is a very low level of homes under construction. That's one of the worst situations that we have seen in 5 or more years. So right now, we've got a combination of issues, interest rates being too high, zoning and other problems in cities, and just no houses being sold. And that's usually the area that responds the most to Fed rate cuts. So a lot of people with their fingers crossed besides the president.
Michael McKee, thank you so much. Great reporting as always. Let's continue the conversation. Chen Zhao of Redfin writing record high home prices and near all-time high monthly mortgage payments are causing many buyers to reconsider their purchases. Chen joins us now. And Chen, you wrote that in June alone, just over 57,000 home sale agreements nationwide were canceled. How does this pair with the stories of strength and economic resilience that we keep hearing about?
Yes, thanks so much for having me today, Lisa. So what Redfin found in our data is that in June, about 15% of the signed contracts for buying a home were canceled. And this is a little bit higher than what we saw last year when it was around 14%. And, you know, also the previous year, and which is also an increase from the years past. So we've kind of been gradually seeing this proportion tick up. And what's really interesting is that that's just a national average. If you look in certain markets, especially in the Sun Belt or in Florida in particular, that proportion is actually closer to 20%. So when we talk to our agents, what we're finding out is that this is really predominantly because of two reasons. One is that, you know, consumers are a little bit nervous. There's been a lot of economic turmoil these past few months, and even though consumer sentiment has sort of bounced back from those troughs, it's still quite a bit lower than where it was last year. So people are nervous. And then the second reason is really just that if you look across the country right now, most of the country is in a buyer's market. The housing market has really shifted. So last month, Redfin, we used some of our proprietary data to release a new metric on how many active home buyers there are out there. And what we found is that right now there's about 34% more home buyers than home sellers. And you really have to go back into the aftermath of the financial crisis to see a proportion that high. So right now, what does that tell us about home buyers? It tells us that people have a lot more choice. So what we're hearing from some of our agents is that, you have a nervous consumer, but they also have a lot more power than they've had over the last few years in the housing market. And when a better home comes along, sometimes they're backing out.
Why are prices still high then? You'd figure that in that sort of scenario where it's a buyer's market, home sales are hitting 17-year lows, that it would be a market that would, I guess, work properly and bring down prices with it.
So we are actually seeing that right now. So we do see that home price growth is slowing down. So if you rewind back to the beginning of the year, home prices were growing probably 5-6% year over year. Right now, it's down closer to about 1 or 2%. And you're seeing that momentum continue. So I mentioned that metric about the ratio of the number of buyers to sellers in the housing market. And what we've seen is that if you look at that and then you compare that to price growth, it actually leads home price growth by about 3 to 6 months in a very reliable way. So what we can say is that we really expect that by the end of this year, home prices are probably going to be pretty flat. And they might even be slightly negative year over year. And that is really important for home buyers because, incomes are continuing to increase about 4% a year, right? Inflation is about 3%. So in that environment, when nominal home prices are flat or maybe slightly declining negative 1%, that means that even when mortgage rates are staying pretty high, buyers are getting a little bit of a break on affordability.
So how much do mortgage rates have to come down to boost prices again, to get activity back in the flow and to get builders back on the front lines?
So I think that mortgage rates is one part of this equation, right? We are definitely not expecting mortgage rates to come down into those 3s or 4s again. It is possible that I think in the more medium term, you might see mortgage rates coming down into the 5s, maybe the mid or high 5s. And if that is the case, I think after 3 years where you've seen mortgage rates close to 7%, that will feel like a significant break. And that emotional part is actually pretty important for a lot of home buyers. But it's not just mortgage rates, it's also home prices, right? Because buyers are focused on what is my mortgage payment. So I think if you have mortgage rates coming down a little bit, and then at the same time you get that price easing that I'm talking about, that could really start to spur some activity in the housing market.
Chen Zhao of Redfin, thank you so much for being with us. Chen Zhao there, who runs our economics team looking at the housing market. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Alphabet's Google has sealed a $1 billion deal to provide cloud computing services to software firm ServiceNow. Sources telling us here at Bloomberg, ServiceNow committed to spending $1.2 billion over 5 years as part of the agreement. Earlier this year, Google also added OpenAI as a customer and secured a $2.5 billion commitment from Salesforce. Meanwhile, federal officials are considering putting a lien on Harvard's property over allegations of mishandling of anti-Semitism on campus. The proposal was included in a memo revealed in last week's court filing. So far, no lien has been filed with authorities. The White House would not say whether it dismissed the idea of that lien. And a development in the Coldplay Kiss Cam saga. Astronomer HR Chief Kristen Cabot has resigned just days after the CEO, Andy Byron, stepped down. The company announced it launched a formal investigation into the scandal that placed both on leave. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. The memes, of course, live on. Up next, the president's push for cheaper crude.
We're number one in the world in oil, and we're drilling, and today it hit $64 a barrel, which is great. And that'll help stop wars, actually, if you want to know the truth.
Francisco Blanch of Bank of America joins next. You can't stop the optimism. It just keeps getting filtered into markets in this slow grind higher in a July that has slowed down quite a bit. Right now, you're seeing just that marginal grind higher in S&P futures ahead of a massive week next week. 38% of that index market cap will be reporting earnings. Under surveillance this morning, the president's push for cheaper crude.
You know, we have the most oil of any country in the world. We're number one in the world in oil, and we're drilling, and today it hit $64 a barrel, which is great. and that'll help stop wars, actually. If you want to know the truth, it's going to help stop wars. And we hope to get it down a little bit more. It's one of the reasons that inflation's in check.
And that's certainly something a lot of people have been commenting on. Here's the latest. President Donald Trump keeping up the pressure on oil producers to maintain lower energy prices. Francisco Blanch of Bank of America writing this. We project Brent and WTI to average $67 and $64 a barrel, respectively, in 2025. Francisco joins us now. And I guess that you could ask, why are prices not lower, considering all of the supply that we see coming out of the Middle East and this push for drill, baby, drill in the United States?
Thanks for having me, Alicia, once again. It's funny, right? So we're getting a weaker dollar. We're getting slightly lower oil, potentially lower rates at some point, right? It's all going according to plan. I do think one of the issues that has been supporting oil has been the seasonal strength of the summer months. But as we go into the second half of the year, we are going to likely see lower prices, and that's because inventories are most likely to build outside of China. Remember, in the second quarter, we had a surplus, but 97% of those barrels were stored in Chinese strategic reserves. And can you blame them after all the volatility we've seen in the Middle East, Russia, Ukraine? So the Chinese are acutely aware of the geopolitics and the fact that they're the biggest oil importer in the world. So 12 million barrels a day. So they have a huge exposure, whether it's the Strait of Hormuz or Malacca. They still rely heavily on oil despite all the electric vehicles that they keep pushing into their market. So I think that's been part of the story. My sense is they'll keep building inventories, but they almost have 40% of all oil stocks globally at this point, crude oil stocks, that is, right? So I do think second half of the year, the surplus is going to be close to 200 million barrels. And eventually we're going to spill out from Chinese inventories into the Atlantic Basin, into the US and Europe. And that's what's going to allow prices to come off. How much are we going to come off will depend on how much OPEC Plus keeps pushing barrels out. Because we've seen the rig count in the US is already coming down. It's down 15%. So my sense is that we'll see lower prices, but not necessarily prices crashing.
Given the geopolitics and given the supply-demand dynamics that you were just talking about, how divorced is the price of oil from an economic cycle that seems to hinge on a new industrial revolution that 10 years ago would have included a huge use of oil?
This is a very, very good point. And when you think about the energy demand we're seeing today, it's in some places in the U.S. is astronomical. I mean, Texan power demand is up 5.5% year on year. I mean, you can barely find an emerging market that's growing at that pace, right? I mean, this is like insane. So I think if you look at the next few months, the majority of the demand, and probably next 2-3 years, the majority of the demand for energy is going to be still renewables, also natural gas, which is what makes us relatively constructive on Henry Hub, and even into the summer on TTF, European gas. But for oil, it's not going to touch it immediately. It's going to take a little longer. I'm not even sure. Oil is a transportation fuel for the most part. So it's kind of left by the wayside in this AI revolution for more energy at this stage. Maybe later on it may not, but for now it is.
Can you talk about that later on point? What could it eventually look like?
Well, I mean, I think if you look 5 years out, the demand growth rates we're seeing for energy, they're going to be pretty hard to meet. And remember how we've evolved 2 years ago. The big tech companies were looking for clean sources of power. They're like, oh, we just want to use super clean power and then, renewables and this and that. And then they said, well, maybe renewables and nuclear. And now it's like renewables, nuclear, gas. Now it's like, oh, just give me any power you can find because we really need a lot of power. I mean, we need, so there's talks about building 10, 15 gigs of power in Pennsylvania. There's you have the eastern border is going to need a lot of power. Texas already, growing beyond belief, and even other parts of the U.S. where you have these data centers, Pacific Northwest, you're going to have a lot of growth. And then eventually Europe as well. And the U.S. has a capacity problem. The U.S. needs to build those power plants. Europe, because it's destroyed its energy consumption in the last couple of years as a result of Russia, Ukraine, actually it does have the capacity. So it's going to be an interesting balancing act in the next 2-3 years for power too.
Well, just on that point, we finally have a ban on Russian imports coming into effect for Europe. And Total Energies, one of the biggest energy players in Europe, was saying, look, we have a tightening diesel market because of this. Right. How played out is this? Is there going to be more stress and tension in the market and tightening of supplies as the ban really starts to come into force? There
could be, certainly. And you also have to ask yourself, okay, so there's this ban on secondary resale, because the issue is, of course, Europe doesn't want to buy diesel that has come from originally Russian crude oil, which, as we know, is going mostly into India, but also into China, right? So Europe's been buying oil from refiners that actually do purchase Russian crude, and that's been one of the issues. But Europe still purchases 15% of its gas directly from Russia, right? So that goes for Belgium and France and Spain and Italy, and does it make its way into Germany too? So Europe is trying to really cut its dependency on Russia, but it's a tough thing to do because, again, only 3 years ago, or 3.5 years ago, 50% of European energy, oil, gas, and coal, came from Russia. So they're trying to do it progressively, and in the process, it's not been helping European industry, but that's kind of, I guess, part of the price that Europe is ready to pay.
Francisco, before we let you go, I'd love a comment on gold, the solid gold, the solid oil that we've seen in terms of just how people are treating it. We've seen prices double since 2022 to more than $3,000 an ounce. And I just wonder how much higher you see it going as you hear an increasing amount of people point this out as the haven asset, as there are real questions around fiat currency.
Right. So we have to be clear. Just like we are bearish on oil and we're constructive on gas because of the power story, we are bullish on gold as well. We think gold is eventually going to get to around 4,000 per ounce over the next 12 months. Having said that, gold needs more investor demand. The story has been mainly a central bank story, and of course, there was a nice tour yesterday of the Fed building. We saw that, right? So. The pressure is on for the Fed to cut rates, and obviously people are going to question independence, and one of the beneficiaries of that questioning is going to be the gold market, right? So, to what extent this this pressure builds on the Fed, political pressure, I think that's what will ultimately trigger a higher price for gold. But remember, jewelry demand for gold is down 20% year on year, so. So the real beneficiaries year to date of the gold upside pressure have been the other metals, the other precious metals like silver and platinum and palladium. So gold is doing well. It's still picking up momentum, but it's already a $20+ trillion market, right? There's $20+ trillion worth of gold out there. Remember, U.S. Treasury is in the hand of the public. 20 trillion or so, right? In the U.S. public. Now you have the foreigners, which own another 9 trillion. But gold's gotten very big, and to get another leg up, you need lower rates. When this happens, and particularly if those lower rates come on the back of political pressure, I think gold will get another leg wind.
All I can say is we saw a tour of the Fed. I would have loved to see a tour of Fort Knox. That's all I can say.
That's where they should meet next time.
Exactly.
Powell and Trump at Fort Knox.
I would like to see that tour. Francisco Blanch of Bank of America, thank you so much.
Right,
great to see you as always. Coming up in the next hour, David Stubbs of AlphaCore, Brian Vaccaro of Raymond James, Greg Daco of EY, and Vishal Khanduja of Morgan Stanley. This is Bloomberg.
I think we've had a great run. I think investors should feel good about that.
The AI theme has kicked back in.
The AI bullishness is there. I don't think that has changed.
Overall, these foundational supports are what's driving markets.
I do think investors do need to prepare for what could feel like a very different second half.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. 90 minutes until the start of trading, grinding upward ahead of a massive week of earnings, with 38% of the S&P set to report next week. A big week for the Fed as well. Central bankers preparing to hold rates steady despite pressure from the White House. And of course, all eyes on the jobs data to end the week. Danny Berger in John and AMH are off today. Danny, it is wonderful to have you. Can we make it day 5 straight consecutive days of new record highs in the S&P?
Considering this is a market that is, not paying attention to anything or doesn't care about anything, sure, why not? And the fact that earnings have held up, it's reminiscent of where we were to start this year. Expectations that M&A is going to get better, hitting all-time highs. Even meme stocks are back. It's led to some to say, like Michael Hartnett, that it's the makings of a bubble, something that Max Kettner at HSBC said What bubble? Fundamentals are good. We can keep going higher.
Well, let's dig into that. Michael Hartnett making the argument that if you have governments that are deregulating some of the investment landscape for particularly retail investors, and you have central banks that are dropping rates, even though there is this strength in the economy, you are going to get those animal spirits that can get over their skis. A lot of people not really seeing this as the case. And frankly, one of the things that's interesting is people have been ratcheting back their expectations for how much central bankers around the world are going to cut rates because of the strength that we're seeing in the economy.
I think that's so important because one of Hartnett's tenets is this idea that it is global central banks that are pushing back, that are starting to cut rates and allowing these things to go on as spending continues in governments. What happens if we get more of what we got from the ECB, saying we're in a good place? We don't need to continue to cut. Does that mean that for all these fears of a bubble, they're just not there? If it are central banks that are starting to pause?
Well, right now we're looking at the potential for also a Fed chair to have a pretty awkward Fed meeting next week, especially after the image that we have replayed on repeat, just simply because it was made for playing on repeat, which is the hard hats, et cetera. On Wednesday, we do get that Fed decision where central bankers are largely expected to remain on hold. How fraught will that become, given some of what we heard just yesterday?
I was going to say, sometimes Powell gets up there at a press conference and looks kind of uncomfortable. I think I'm going to retract ever saying he looked uncomfortable, because we saw what it actually looked like to see Powell uncomfortable, kind of chuckling off some of the comments from Trump. But maybe that face-to-face interaction had the net impact of taking some of the heat off, that they just needed to get in a room together, hash it out, put on their hard hats, take off their hard hats. But it's the unavoidable. The Fed chairmanship comes up, and next year, that's going to be the real point of concern. Who comes in next? Is it someone that is going to listen to Trump more acutely and really start to cut rates more than they otherwise would have?
Right now, the market is closing their ears, and they are just saying what we are watching is the earnings, at least when you take a look at the equity markets, the investment that you potentially see coming in from the AI boom. We're seeing S&P futures retrace some of the earlier gains, but still positive, up about less than 0.1%. You're seeing a bit of dollar strength after yesterday's jobless claims came in less than expected. A little bit grind higher in terms of yields, although not that dramatic. Coming up this hour, David Stubbs of AlphaCore following a fresh record high. Brian Vaccaro of Raymond James after Chipotle cut its forecast yet again, despite those free burritos. And Greg Daco of EY with the labor market on solid footing, at least for now. We begin this hour with stocks steady after hitting a fresh record high on AI optimism. David Stubbs of AlphaCore writing this: short-term caution given where markets have run to, seasonally weak, and thin August markets await. David joins us now. And David, you are probably the first person that we've had on this show this morning that has sounded a note of caution. So congratulations. What kind of response do you get from clients when you say, hold on a second, this has run pretty far, maybe it's time to take a break?
Well, good morning, Lisa. Great to be with you. I think we're just observing, obviously, a pretty frothy set of markets right now. You've covered how many record highs we've hit. The meme stocks are back. And you have the combination of high valuations, low volatility, and very tight spreads across credit as well. And markets just in a particularly joyous place right now going into August, and we all know that liquidity tends to be thin in August. Accidents do happen in August. So look, at AlphaCore, we're not particularly tactical. We're not de-risking notably around this. But just looking at the setup and watching your show all week and how many people have talked about the extraordinary things we're seeing in some of the equity markets, you have to wonder, are we going to see some volatility ahead in the next couple of months? Certainly plenty of triggers for that await us.
Do you have to care about the volatility if ultimately the path is upward? I mean, I guess we hear about people coming on the show and they'll say, yeah, we've got volatility ahead. August tends to be a rocky month and we're going to be in there buying that dip. I mean, can you get very enthusiastic about a dip that you have 15 buyers lined up to buy?
Yeah, absolutely. I think you always have to care about volatility. A lot of wealth management clients will get scared when there's a drawdown. And I think we think about that by incorporating alternatives and private markets at the core of portfolios from the start, always and forever, as it were. And also utilizing alternative strategies, things like uncorrelated managers, to reduce drawdowns in most scenarios, build structurally resilient portfolios. And I think that's our focus. And I think that when you look at a collection of opportunities we see over the next few years, there's a lot to like about the technological innovation we've just had. Obviously a lot of fiscal support. There's a deregulatory impulse in the United States right now as well. Over the medium term, that keeps us invested. But you have to recognize how far we've come at the moment. So I don't think we'd be piling on extra risk here. But I do think we see a collection of themes playing out over the medium term that we want clients to have exposure to. We'll just pair some exposure in liquid markets, great public equities are a great asset class, with those in private markets as well.
David, one of the issues you write about that suggests that positioning is getting stretched is this idea that defenses are getting crushed relative to cyclicals. We were talking with Alicia Levine of BNY Wealth earlier, who said that part of the reason that cyclicals are doing well is because of the massive capital expenditure spend that's coming from some of the hyperscalers, that's inducing more industrials to outperform. Is that not a theme that could endure, or is it really a sign that things are getting stretched here?
I think it's a very enduring theme, but we all know that equity markets can price things in aggressively, and they've come quite a way already. I think that the CapEx AI theme is not just a narrative for the equity market, it's a narrative for the economy. I mean, if you look at the Secretary Bessent's tweet from earlier in the week, talking about the strength of capital expenditures, up around 17% annualized, I believe, in the first half of the year. Look at the data center energy nexus that's at the heart of many thematic investors right now. And we're believers of that in the medium term, for sure. I think the huge question that awaits all analysts is how long does this run? And then how do you pivot your AI investments away from capital expenditures towards the rest of the supply chain, and indeed towards AI? When does that happen? I think it's still years away, don't get me wrong. But I would give one example of positioning where we're trying to take a broader approach than just buying these massive AI plays. We're actually long an active growth manager right now in our equity holdings. Instead of being long, the Nasdaq on its own, we're hoping that active managers in the growth theme will not go after the obvious AI plays, but will find some AI adjacent stocks as well as the theme continues to mature. So we're very optimistic about that. We like to play it both through public markets and private markets, as always. But there's just one measure of positioning that we see at the moment: cyclicals versus defensive, and it's come a long way.
David Stubbs of AlphaCore, thank you so much for being with us. That was David Stubbs there talking about why, even though they do see volatility ahead, they are still optimistic. I think this is an interesting discussion, the idea of private markets and what role they're going to play in the whole AI infrastructure build out, and this argument that it isn't just about taking less risk. It's about another way of investing in infrastructure that has maybe a different maturity profile.
Well, it also becomes a self-fulfilling prophecy if you say private markets offer a better diversification right now, because what we've seen is that private companies are staying private for longer, that public equities are shrinking. I think over the past 5 decades, number of public companies have shrunk by half. So what happens if it's an investor base right now that starts turning to private markets, that for retirement funds, they start turning to private markets? If more capital goes there, does that mean less public companies? And if there are less public companies, does that mean less robust indexes and exchanges? So it could have this snowball effect. And I think it's just something to keep an eye on as more and more people start saying, for our clients, we want them to look at alternatives.
Right now, let's get you an update on all the alternative stories this morning. Here is your Bloomberg Brief with Yahira, Anna, and Yahira.
Hi, Lisa. Here's an alternative story. President Trump put on a hard hat and toured the renovations at the Federal Reserve with Chair Powell. And as we've been playing all morning, there was a tense moment when the president claimed the price tag had jumped from $2.5 to over $3 billion. In response, Powell said Trump's claim included a building that had already been completed 5 years ago. Meanwhile, Alphabet's Google has sealed a $1 billion deal to provide cloud computing services to software firm ServiceNow. Sources telling us here at Bloomberg, ServiceNow committed to spending $1.2 billion over 5 years as part of the agreement. Earlier this year, Google also added OpenAI as a customer and secured a $2.5 billion commitment from Salesforce. And the Trump administration is suing New York City over its sanctuary city policies. The laws at issue prevent law enforcement from honoring a civil immigration detainer without a warrant. Mayor Eric Adams responded saying the laws go too far and need to be re-examined. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the morning calls, plus Brian Vaccaro of Raymond James with Chipotle cutting its forecast again. We'll get into the nitty-gritty of free burritos and free chicken and why that wasn't enough to stem some of the weakness that we're seeing in Chipotle Mexican Grill. This is Bloomberg Surveillance.
I have real trouble, both with weakness in the labor market and with a more hawkish Fed, that really changes the picture. Because once again, it's the growth, it's the earnings picture that is really, really solid. And I think that really puts into question that notion of this being a bubble. I think the rally can stay for at least through the summer.
That was Max Kettner of HSBC getting triggered by the concept of a bubble and saying absolutely not. Right now, it is we're looking at markets that are climbing after 4 consecutive days of record highs. S&P futures up just about 5 basis points. And really a question here about whether we can make it day 5 of new record highs, just with marginal gains every day inching higher for the 5th consecutive day. Time now for the morning calls. First up, Jefferies raising Union Pacific to buy, noting its potential tie-up with Norfolk Southern could be transformational. Those shares up about 0.5%. Next up, Loop Capital downgrading Ulta Beauty to hold, saying its bullish outlook is largely priced in after the fad for 10-year-old girls tends to wane. Those shares lower by about 1.4%. And finally, Bank of America raising its price target on American Airlines to $13, noting slightly better unit and revenue costs. Those shares higher by about 0.6% after having a difficult session yesterday. The earnings not giving the same type of optimism as we heard from Delta and United. Sticking with the consumer, Chipotle falling the most in 5 years after cutting its annual outlook for the second time this year. The company saying its honey chicken launch and burrito giveaways weren't enough to offset a slump in traffic. The story you've been wanting to hear about all morning. Michael Halen, Bloomberg Intelligence senior restaurant analyst, joins us now. What went wrong? Free burritos, honey chicken. What exactly has been the problem right now for Chipotle?
Yeah, you know what? They didn't really give us much color on this call about that. You know, it was a weird call. I didn't think it was a very good one for the management team. It was heavy on excuses, very light on details. You know, they mentioned that honey chicken did really well. So a minus 4% same-store sales comp indicates their base business is declining pretty rapidly, right? And they said there were no missteps, but in the first quarter call, they said the stores were dirty and the hospitality was poor. So which one is it, right? And when you underperform the index, the black box index, which we use by 430 basis points, I mean, it sounds like there were some significant missteps here. You know, we suspect value is an issue. You know, they've been investing in larger portion size to address that over the last year. But then at the same time on the call, they say that, you know, we think we provide good value. So honestly, it was a pretty confusing call. I think investors really, have doubts now about their ability to get back to that mid-single digit same-store sales growth.
Michael, I was listening to the same thing on the call when they basically said, we think we provide value, that we're not going to offer something that looks cheaper. We just need to do a better job of communicating the fact that we provide value for the consumer. Is that the right tactic that Chipotle should be taking?
You know, it's hard to say. I mean, a lot of things have to be going wrong when you're doing a -4 same-store sales comp, right? Especially in a restaurant environment that's not that bad. You know, fast casual same-store sales were up, not a lot, but they were up, 30 basis points in the quarter, right? So if you're underperforming by that much, there's a lot of things going on. On the first, like I said, on that first quarter call, they talked about some operational issues. That's typically where you start to see some slippage, right, is on the operations, and CEO Scott Boatwright was the former chief operating officer, right? So I think nailing those operations probably is the first piece. And in terms of the value, we're not sure. Maybe they need to make another investment in the portion sizes, right? Some of the companies that we cover that offer the most food for what you pay tend to outperform. So think Texas Roadhouse, Wingstop, Darden. These companies have the highest food costs of all the companies we cover. People recognize that. They recognize the value that they get for their dollar, and it lifts traffic.
Michael Halen of Bloomberg Intelligence, thank you so much for being with us. And I look forward to parsing through all of the different restaurants and fast casual dining that we all know and love. Joining us now, Brian Vaccaro of Raymond James, which has an outperform rating on and $60 price target on Chipotle. He joins us now. Brian, thank you so much for being with us. I want to start with what we were just hearing from Michael Halen, who was not impressed by the call, and take a step back and just say, how much are you seeing differences in execution during this earnings season between the haves of the fast casual restaurant chains and the have-nots?
Yeah, thanks, and good morning. Nice to see you. I think what I would say is to start would be we need to maintain perspective here. We need to maintain some perspective of how strong Chipotle has been over the last few years, and especially last year in the second quarter. So when you see the down 4% comp, we do need to maintain perspective that they were up against an up 11% last year, which included the month of April up in the high teens. And so this is a business that in some ways caught lightning in a bottle in April with the second year of the return of Chicken Al Pastor. That was a huge hit last year. So the 2-year run rates are much less concerning in our view, though it does seem that they have seen a moderating in trends that we need to get a better assessment of and a better understanding of. And I think over time you'll see that. When you see businesses, I'll say this to the general comment, when you see businesses that go from explosive growth and outperformance to a little bit of outperformance, there's always a lot of contributing factors to that to keep in mind. And one of the things that we've talked to them offline about and been asking about is some of their internal guest satisfaction and operational scores. And those metrics continue to show strength. Yes, they had the portion size issue last year, which they addressed in a cohort of their stores, 10 or 15% of their stores, I believe. But I do not believe that they have a value proposition issue at all. In my local market, it is $9.50 for the Chipotle chicken bowl or burrito. And in many of the quick service restaurants or in the area, those value meals start in the $10 to $10.50 range.
Yeah.
So I think from an absolute price point perspective, Chipotle continues to have a very strong value proposition.
What I'm struck by, Brian, is the conversation we're not having this morning. We're talking about Chicken Al Pastor and we're talking about $9 chicken burrito bowls, but we're not talking about consumers that are pulling back wholesale or any kind of macro problems that these companies are facing. Is that really an accurate portrayal of the landscape, that that the consumer is solid, that any kind of supply chain disruptions are manageable, and that really this comes down to when you roll out your Chicken Al Pastor?
Well, I think, so far we have 2 companies under our belt so far in Q2 earnings season, and we're seeing results that point to a mixed and choppy consumer backdrop with some clear differences between the lower and middle upper income consumer in our view. At a high level, I think the lower income consumer seems to be under pressure. We're expecting to see that in softer sales results for most quick service restaurants this earnings season. And on the flip side, the middle and upper income consumer seems to be doing okay. And we've actually seen some stronger sales trends within the casual dining sector, which we haven't seen in many years. That would be the sit-down category of restaurants like Olive Garden, Chili's, and Texas Roadhouse. Those brands, that sector underperformed meaningfully in 23 and 24. And we're seeing that snap back here with casual dining comps that were up about 4% year on year in the second quarter. It does seem that the jobs and income backdrop remains pretty supportive in the aggregate, but the big swings in consumer sentiment are likely weighing and contributing to the choppiness and at times have created a few air pockets through the first half. And we talked about Chipotle on this week's call. They did notice they saw some softness in May, and they attributed that to the big decline in sentiment that we saw more broadly. And obviously that was following the big market pullback in April as well.
Brian Vaccaro of Raymond James, thank you so much for being with us. Right now, we want to shift gears back to the Federal Reserve, responding right now to the visit between President Trump and Chair Powell yesterday. Bloomberg's Michael McKee joins us now. Mike, what's the latest?
It was apparently quite the honorable meeting. The president yesterday posted that he was honored to tour the Fed. The Fed today saying they were honored to have him. In a tweet just posted on social media, the Federal Reserve says they were honored to welcome the president yesterday for a visit to our historic headquarters. We appreciated the opportunity to share progress on the renovation with him and with Senators Tim Scott and Tom Tillis. They're grateful for the president's encouragement to complete this project, and they say they remain committed to continuing to be careful stewards of these resources as we see the project through to completion. Now, this has been sort of a hallmark of the Powell Fed in the Trump years. The president can say whatever he wants, and the Fed either doesn't say anything or responds in a very nice manner. They don't seem to want to pick a fight with the president, other than Powell saying he would not resign. So maybe this brings an end to some of the squirrel aspects of this whole Fed renovation issue. We may not see quite as many tweets on that from the president. And certainly not from the Fed, but I'm sure if the Fed does not cut rates next week, we'll hear from Mr. Trump again.
I'm sure that we will. Michael McKee, stay close. We're going to come back to you in just a minute. And it is amazing how much we have been shrugging this off, because it is a very made-for-TV moment, which is what President Trump does very well. But it does raise a question about this sort of blanket approach to get the Fed to lower rates ahead of next week's Fed meeting.
Right. It's everything kind of thrown at the Fed at this moment, from issues about the construction of this to are they getting things wrong because housing prices are still high and mortgages need to come down. It's something that's been difficult for the Fed to try to respond to. And they've been trying to respond to it in bits, from posting blog posts saying here's why the building overruns aren't that big of an issue, to trying to justify why rates stand where they are. It's something that Powell's going to have to deal with next week. It is real political pressure. But if anything, a lot of comments have been made how that pressure has made Powell more steadfast. That's made him less likely to cut, because he wants to be remembered as a Fed chair that stood up to that political pressure.
Watch the dissent. That's what people are saying. You're going to see maybe Chris Waller, maybe Mickey Bowman, both saying, well, maybe we should have cut. Coming up, we're going to discuss that and more. Greg Daco of EY with the labor market on solid footing. Plus, Yahira Anand with your morning movers as Intel slides with concerns around that turnaround plan. This is Bloomberg Surveillance. Looking to make it day 5 of record highs at the close, just inching higher. And it is remarkable, as Danny was mentioning earlier, just how little activity there is behind each day of a record high. Right now, S&P futures up by 0.1%. Russell 2000 futures up about 0.3%. In the bond market, a little bit of a lift in yields, priced down after what we saw yesterday from the ECB when they came out and seemed to indicate they weren't going to necessarily cut rates again anytime soon. You're seeing this across the board. It's across the curve, but nothing particularly dramatic. And then when you bleed it out through the currency space, a bit of dollar strength, especially on the heels of some economic data that came out yesterday, jobless claims. With the right kind of downside surprise, you're seeing euro dollar 117.25. Still the calls coming from the likes of George Saravellos of much more euro strength ahead. Economic data has been very much in the forefront, crossing right now ahead of a busy schedule next week. Bloomberg's Mike McKee joins us now.
We have durable goods orders out, and they are down 9.3% after rising 16.5% last month. Now, when you have a swing that big, it's usually because of Boeing and the timing of their orders. I'll check that out for you. Ex-transportation, durable goods up 0.2%, also underlining that idea. Capital goods orders leaving out non-defense aircraft were down 0.7%, though. That's the part that goes into the GDP numbers, and so that's a little bit worrisome. They were up 1.7% the month before. We will have to see what the problem is there. The Fed is going to be worried about a slowdown, of course. One of the questions about business spending has been, did companies just load up on inventory and spend it down and not put in new orders, waiting to see what the consumer is going to do? This will be a discussion point for the Fed next week, but they are not expected, as you have been saying all day, to do anything, not to cut rates at all. What we're going to be looking for is whether or not the Fed is going to see dissents from two governors for the first time ever. And the markets are going to be also watching for future cut guidance. There's a lot of feeling they might set us up for a September cut. Looking at durable goods, looking at what we get in terms of jobs next week and saying, well, maybe we're seeing some signs of this or that we want to move on. And I think we can predict that no matter what, Donald Trump is going to be unhappy and will tweet about it either way. We have seen some inflation in the last couple of CPI and PCE reports. We get PCE next Friday too, or next Thursday rather, after the Fed meeting. But the Fed could point to that and say that's why we do not want to cut, which puts the emphasis on those later meetings. July, September, October, December, 4 meetings left this year, 2 cuts priced in. Do we really get that? That'll all depend on the data. And while I look up what happened with Boeing, I just want to say I, too, am honored to have been here for this show, like the president and the Fed.
Thank you so much, Michael McKee. With a look ahead, right now you're seeing priced into Fed funds futures a 64% chance that the Fed will cut in September. So to what Mike was saying about setting up the market for that September rate cut. Greg Daco of EY writing this: economic activity is decelerating, even as inflationary pressures are reemerging. This tension is likely to persist through the summer. Greg joins us now. And Greg, we just had a lineup of people all saying that the economy is going strong. People are just deciding which fast casual restaurant to go to. And there definitely does not seem to be the same kind of inflationary pressure that many people thought would be the case. Why are you maintaining this idea of a stagflationary push that just hasn't shown up in the data yet?
Well, I think it hasn't shown up in the superficial data. But if you lift the hood, you're going to see the signs of this stagflationary move. If you look at the recent developments in terms of inflation, we estimate that about a third to a fourth of the push in inflation in the month of June was actually coming from tariff-induced price pressures. So it's there. It's slowly starting to emerge. And I've written in the past about the fact that it's not that we're not seeing the tariff pressures. It's that they're taking some time to filter through because businesses have been managing inventories, because they've been using bonded warehouses and foreign trade zones, because the effective tariff rate is not quite yet at the average tariff rate, and there is a gap between those two. All these measures are delaying the inflation pass-through, but make no mistake, it is materializing, and it will affect us with more and more pressure over the course of the summer, which will feed into how consumers spend. And we're seeing these signs of pressures on the consumer already. If you look at retail sales, the categories that were most affected by the tariffs are the ones that are suffering the most.
So what happens then if we feel the real effects later this year and early next year? At the same time, we're starting to get Fed cuts, and you're starting to see the one big beautiful bill, some of the stimulus flow through from that.
Well, I think it's important to distinguish all of the different details that are affecting the economy. There are a lot of cross currents which make for this very confusing economic picture. But the reality is that the economy is decelerating. If you look at the labor market momentum, it is actually decelerating. Slower job growth, more concentration of job growth in a few sectors. We are seeing continuing claims for unemployment that are rising, even though after the hump we saw initial claims come back down. We're seeing the hiring rate at a 10-year low. All of these factors are factors that drive income growth, the key pillar to consumer spending activity. And that is weighed to the downside. So that's going to be a constraint for consumer spending as we navigate through the second half of the year, at the same time as inflation pressures are ramping up. And about that fiscal bill, that is not going to provide a lot of stimulus in terms of the U.S. economy. The major thing the One Big Beautiful does is prevent the expiry of a number of tax provisions from the Tax Cuts and Jobs Act. That prevents a drag on the economy of 1%. But the actual net boost to the economy, we calculate will be around 0.2, 0.3 percentage points of GDP. Not a big benefit for the cost of that bill.
Well, the other factor to put into this too is also what we might see in terms of a supply shock to a supply shock in the labor market, going from something like 4 million people coming into the U.S. a year, a lot of them working age men, going to something like just a few 100,000 per year. Have we started to see the effects, and what will the effects be going forward?
I think that's a much under-discussed topic, the immigration topic, because we are in an environment where increasingly economic activity is driven by supply-side factors. Whereas before COVID, it was all about demand side factors. Now it's increasingly about supply side factors. It's the supply of labor. It's the supply of capital. It's the supply of energy. It's trade and logistics. And when it comes to immigration, you're absolutely right. It's been a key driver of economic activity. If we start to see less immigration, that is going to do a couple of things. One, it will weigh directly on spending because there are fewer people that are spending less, in part because they're fearful. And two, it drives lower supply, lower labor supply, which weighs on employment growth, which weighs on your economy's potential to grow. Combined, all of these represent a drag of about 0.3, 0.4 percentage points over the next year. That's more than the one big beautiful bill that we were just discussing.
It's one reason why people are looking at this miss on capital goods orders that include non-defense aircraft as being particularly notable. Stay close, Greg, for 1 second. Michael McKee, you've got some more details on what exactly was behind that.
It is sometimes fairly easy to figure out durable goods orders when you have these big swings. It's usually Boeing. They reported a decline of 51.8% in new orders for the month of June, Boeing and some of the smaller little private plane makers. And that compares with a 231% rise in the month before in May. So you can see why we get these big swings. Unless you're Danny Berger, you're not buying a new Boeing jet every month. We also saw a decline in manufacturing orders of 12.8%. That's something the Fed will keep an eye on, along with computers and communications equipment. They both were down on the month, and this may signal that business is sitting on its hands. One last note, capital goods shipments were up 0.4 after a 0.5 rise the month before, and that was double what was anticipated. So maybe we have a little more strength in the second quarter, the rebound from all those imports, et cetera, that we saw in the first quarter. Those numbers will feed into better than expected, perhaps second quarter GDP, which we get on Wednesday when the Fed is making its decision.
Thank you so much, Michael McKee. And Danny Berger is here to tell us all about your selection of Boeing jets that Mike somehow put on your radar.
Apparently every month I'm buying a new Boeing jet. You all are welcome to join, I guess. I don't know where we're going with an entire jet, but yeah.
But you know, what Mike is talking about is actually really important. And this idea that we've heard about so much this morning, which is that it used to be just investment in assets and liquidity heavy kinds of corporate investment. Now we're talking about real physical investment in this whole industrial revolution. At what point do you see that really offering a boost to both productivity as well as growth that hasn't been accounted for in so many of the more pessimistic outlooks for the U.S. economy?
Well, I've been an optimistic on the productivity front. Despite the fact that I'm quite reserved in terms of the short-term cyclical outlook, I've been very optimistic about the exceptionalism that we were seeing going into 2025 because it was driven by strong productivity growth that was coming from the bottom up. It wasn't yet the AI lift that we're all talking about. It was actually businesses being more efficient with the talent on hand that costs more in today's environment, ensuring longer tenure, better trained employees are better able to contribute to economic activity. And it was this focus on investing in the infrastructure that will support AI. That is often undercounted. And then on top of that, you have a desire to push more industrial policy and focus on driving more manufacturing investment. It won't bring back the jobs, but it will bring back more economic activity and more potential supply. That is right now undercounted, but it is still one of the key pillars of economic activity driving that stronger productivity momentum.
Does that mean for all the fears of growth slowing and inflation picking up that it's not quite stagflation? Because you have some of these forces, it would moderate the worst case scenario?
Well, I think economic activity is a flow notion, right? And so we are still benefiting from a very robust economy. As I was saying, up until the start of 2025, we had an economy that had been growing at a 3% pace with disinflation. Inflation was moving lower. So we had the best of both worlds. We had essentially strong productivity growth supporting a very strong economy and disinflationary currents. We're gradually moving to the opposite of that, a stagflationary environment where economic activity is slowing and inflation is accelerating. And that becomes a headache for policymakers around the world, but including the Fed, which has to balance these divergence pressures in terms of the employment mandate and the inflation mandate.
Considering the pressure from the White House, inevitably, especially next year when we have a Fed chair appointed by President Trump, does this just turn into a Fed that puts more weight on the growth side of the mandate, even if inflation is still picking up?
No, I think the Fed will have to pay attention to both sides of the mandate. That is what it's supposed to do. But it has to determine whether the pressures from tariffs are one-off pressures, which is the argument that Governor Waller has been making. It's the argument that I've been making for a while now, that essentially this tariff-induced inflation is going to be a temporary one, that we are still seeing significant disinflationary currents, in particular from the shelter side of the economy, that inflation expectations are still well anchored, and that we're not necessarily going to see second-round effects, because the labor market is softening and you're not going to see the types of pressure that we saw during COVID with wage inflation accelerating. In my opinion, that opens the window for the Fed to neutralize monetary policy from a slightly restrictive stance to a more neutral stance with some easing over the course of the next few months.
Greg Daco of EY, thank you so much. Just a note that isn't necessarily as sexy as donning a hard hat and going through the renovations, but maybe that would be the conversation that's more akin to what we get in the Eccles building next week. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Tesla plans to launch its robo-taxi service in San Francisco this weekend. That's according to an internal memo seen by Business Insider. It reports the robo-taxis will have a safety monitor in the driver's seat who will have full access to the brake and steering wheel. Some Tesla owners will be sent an invite to use the service, according to the memo. Meanwhile, meme stock mania made a comeback this week, and traders made American Eagle their latest target after the retailer announced a new campaign headlined by actress Sydney Sweeney. Shares of Open Door, GoPro, Krispy Kreme, and Kohl's also saw a surge this week as traders piled into speculative corners of the market. And we end on some bad news. A massive heat wave is expected to blanket most of the East Coast today. More than 129 million people across more than 20 states are under life-threatening heat alert. Cities from Washington to New York City and Boston will see highs well into the 90s with a real feel of more than 100 degrees. A few daily record highs may be challenged. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Happy Friday. Go off and enjoy it, I guess, as we all try to figure out how to beat the heat. Up next, setting you up for the day ahead, plus Vishal Khanduja of Morgan Stanley on the impact of tariffs on inflation, one of the elusive questions of 2025. This is Bloomberg Surveillance.
Taking a look at what's happening, and it's a tough construction job. It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building, is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
It's part of the overall work. So, well, I'd love him to lower interest rates. But other than that, what can I tell you?
That was President Trump grilling Fed Chair Jay Powell on renovation costs. And I have to say, Danny, do you think they actually needed the hard hats?
Well, the fact that Trump was like, let's take these off. We don't need these anymore. We're out of the danger zone. Probably not. It reminds me when politicians also tour zones with the bright orange vests. It's like the fact that there are cameras everywhere and security, I think, would alert people to the fact that they're there.
But they looked good in them. That's all I can say. Less than an hour away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. Intel is moving away from its build it and they will come strategy. And how are investors reacting? Well, not good. Shares are now down 8.6%, but CEO Lip-Bu-Tan is charging ahead. He plans to cut jobs and scrap some of its major factory projects after it poured billions to try and become a chip foundry powerhouse, but no longer. And the disappointment didn't stop there. It also guided lower on margins and offered little to no clarity on how it plans to compete in AI. And it was a blowout quarter for our next stock, and that is Dockers. Shares are up 11.7%. This is the company behind Uggs and those chunky Hoka sneakers. Sales rose by double digits for both those brands, but it's not smooth sailing from here because this is a shoemaker, so of course it's caught in the crossfires of tariffs. And while it was able to mostly blunt the impact by front-loading shipments, it does say that price hikes may be coming as those costs start to catch up to them. And we end on shares of Paramount. They are up 1.2% after the FCC approved its merger with Skydance, but it came with some strings attached to appease the agency leader, a Republican appointed by President Trump. To secure the green light, the company had to end some of its diversity initiatives and agree to add a watchdog to supervise any bias at the media company. So what happens from here? Well, Sherry Redstone, whose family has run this company for decades, will step down when it's completed, and David Ellison will become chairman and CEO. Lisa?
Thank you so much, Yahira. Have a wonderful weekend, and thank you for this morning. Counting down to the opening bell. Here is the trading diary for the week ahead, and it's a big one. On Monday, we have Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick meeting with their Chinese counterparts in Stockholm. On Tuesday, earnings from Starbucks. Wednesday, a Fed rate decision and a Chair Powell news conference. Some renewed focus on that. Plus, earnings from Meta and Microsoft Thursday. Jobless claims and results from Apple and Amazon. Finally, on Friday, we do get that payrolls report at a time of increasing questions around the U.S. economy. Let's stick with that economic data. Investors looking ahead to next week's Fed decision and other economic indicators. Vishal Khanduja of Morgan Stanley writing this. Given the tariff revenue collections, we believe that the next two inflation prints will be reflective of the tariff contribution. Vishal joins us now. And I am curious about whether this is going to be a one-time price shock or whether this is going to have longer legs, and how much we've really gotten clarity versus just people's expectation that this will be just a one-time adjustment.
Good morning. Lisa, definitely in principle, it should be a one-time adjustment. Again, tariffs, there are only three spots that we can see the effects. Either the exporters eat it up, either companies through their profit margins. We heard a couple of those in the earnings, more on the auto side and the OEM side, showing up with one-time charges there, or it trickles through PPI and CPI here in economic data. We saw a little bit of all of that, less of exporters, more of profit margins, and CPI show us a little bit. I think as you track the revenue from the tariffs and as average rates start to go through the economy, I think the next two prints are going to get a little steamy and a little bit more contribution from there. But we still think it's going to be a one-time bump rather than a lingering effect that we had seen in the prior years on the.
To your point, Vishal, the tariff revenue has been real. We have seen a bump in what the U.S. is taking in. What does that tell you about how sticky these tariffs are for the foreseeable future? That this isn't a story of the next 4 years, but this is a tariff story that will continue on beyond President Trump.
Absolutely. I think if you just remove all the politics, midterms, four-year term, et cetera, out of the picture and just mathematically extend the clock out, yes, this is going to be a consumption tax, which is going to be 5 times more. But then companies are resilient and adjust. I think they will take some profit margin hits, slightly more profit margin sectors with high profit margins will take a little bit more, less on the consumer side. And then consumption will adjust, or consumers will adjust as well. I know we are still squinting to see the weakness in consumption and consumer and labor market, but still there is that sort of underlying weakness that is showing up. And we do think that consumption patterns will adjust. Nominal GDP should adjust down for that matter as well.
What will it take to finally see that show up, Vishal? Because it has been some time since we've seen any of that weakness, despite the constant calls for it.
Yeah, no, I think it'll take time, and that's where it makes the Fed's job difficult. From our perspective, I think why it is difficult to see this and why it's taking time, because balance sheets, both consumer and corporate balance sheets, coming into this 2025 uncertain environment from both fiscal and monetary policy have been extremely strong. I think you're sitting on a consumer who is a homeowner is sitting on 3% 30-year fixed rate. Even the best hedge funds in the world don't get that type of leverage, and their equity is up 25% at least on their houses, and we are running a 4-decade low unemployment rate. So that balance sheet of that consumer is extremely strong to take on some of the uncertainties that we are seeing, and that's why I think it's taking time for it to seep through the economy.
Vishal, you said something in your notes that I thought was fascinating. When you bleed this into the market, you said U.S. assets and U.S. dollar are two separate trades, and this is something increasing numbers of investors are coming around to. Is that something that you expect to be persistent? Bullish U.S. assets, bearish U.S. dollar?
Spot on. I think that's how our portfolios are adjusted today as well. Over the last 7 months, we've adjusted and steered our portfolios in that direction. We're still trying to eke out that positive fundamentals from consumer and corporate balance sheets here. Not saying that there are not some of the idiosyncratic strong fundamental balance sheets in Europe and other parts of the emerging market world as well. But I think that dollar weakness, I think, is coming primarily from that, the urge from the administration. We've heard it time and again from speakers in the, not the Fed speak, but more from DC on that part. And then where the exceptionalism story is landing us, it is much weaker dollar from here rather than what we had seen probably the last decade and a half. So strong fundamentals from consumer and corporate balance sheets, weak fundamentals from the government balance sheets and deficits, which flows into your currency. And that's how portfolios are positioned at the moment.
Just about 20 seconds, Vishal. You said much weaker dollar. How much further does it have to depreciate?
I think in the next probably 2 years, we think that probably around that 10 to 15% in a basket of currencies. We are not picking one currency to go against. In a basket of DM and EM currencies, that's how we've reflected in our portfolios. We do think that there is a double-digit depreciation along the way. Again, the point being that it is not about U.S. Treasury, foreign buyers of U.S. Treasury as a percentage of GDP has actually not changed. It is the foreign buyers of U.S. equities that are up probably 10 to 15% since the financial crisis. That needs to adjust. That's where some of the hedging will come through. And that's why we think that 10 to 15% is how we are thinking about it.
Vishal Khanduja of Morgan Stanley, thank you so much for being with us. Have a wonderful, wonderful weekend. Right now, we are getting some headlines from President Trump touting the great economic numbers, still, though, arguing for rate cut.
Yeah, great economic numbers does not save Chair Powell. We'll see what he says next week after that decision.
And we'll be speaking with a host of wonderful guests. On Monday, we've got Steve Chivarone of Federated Hermes, Jay Pulaski of TPW Advisory, Abby Yoder of JP Morgan, and Steve Rasciuto of Mizuho. Danny, thank you so much. Always wonderful to have you here. Love your contributions. This was Bloomberg Surveillance.